All right, good morning, everybody. And welcome back to docket number 260104, PIRA annual review of the rate adjustment mechanisms of the Illuminating Company. Let me try that again. United Illuminating Company, not aluminum. My name is Tom Wheel. I'm the chairman of the Public Utilities Regulatory Authority. I'm joined today by my prudent colleagues, Vice Chairman David Arconti and Commissioners Jan Beecher, Holly Cheeseman, and Everett Smith. We are here today for the evidentiary hearing in phase 2 of this proceeding. We have an agenda in front of us today. And I know we took appearances from the parties last time, but it's been since March. I'm not sure if all the lawyers are the same. So I thought we could start by refreshing appearances. So if the company wants to go first.
Good morning, Mr. Chairman, Mr. Vice Chairman, Commissioners Beecher, Cheeseman, and Smith. Brendan Vaughn of Keegan Werlin on behalf of the United Illuminating Company. I'm joined by Senior Counsel from UIL Holdings Corporation, Kerry Gawaski.
Thank you. OCC.
Good morning, Kim White from OCC. I'm joined by Attorney Allison McCorney, and depending on timing, Director Andrew Minkowski and Consumer Counsel Coleman.
Thank you. We've got DEEP and CIEC on the agenda. DEEP. Thank you. I don't think I see anyone from CIEC this morning. Okay. Do we have any administrative matters before we actually start the hearing?
No, I don't know if this is a true administrative matter, Chairman Wheel. I would just note that we have a rather large witness panel, as we always tend to do for the RAM. The vast majority of the company's witnesses were sworn in previously, and I would presume, subject to your confirmation, remain sworn for this hearing. The witnesses who do need to be sworn in are Mr. Eric Roby, Ms. Andrea Van Luling, Mr. Jack Jessup, Mr. Logan Tarakani, and Ms. Maritza Jimenez, and no administrative matters beyond that.
Okay, thanks. I was going to ask about that next, but thanks for jumping the gun. And we can do that. Any public comment first, though? Anyone here with public comment? Okay. So yeah, Attorney Vaughn, I can swear in those new witnesses who haven't yet been sworn if they want to approach. That's good. It's a good area. So I'll administer the oath as set forth in General Statutes Section 125. Do you solemnly swear or solemnly and sincerely affirm, as the case may be, that the evidence you shall give concerning this case shall be the truth, the whole truth, and nothing but the truth, so help you God, or upon penalty of perjury? Thank you. So those witnesses are sworn. And Attorney Vaughn, do you want to have the entire panel maybe adopt pre-filed materials that have been filed since the last hearing? Does that make sense?
Yes, that was my plan, was to sort of a brief direct examination to discuss the materials that have been filed since March 9th.
Sure. I think we're ready to go on that.
Ms. Tebbets, Mr. Kolka, Mr. Hurwitz, Ms. Miller, Mr. Stanley, Mr. Daniels, Ms. Chasse, Mr. Whelan, Mr. Crowley, Mr. Romero, Ms. Prescott, Ms. Wasselnack, Mr. Rosa, Mr. Patel, Mr. Marenka, and Mr. Hernandez. You all were previously sworn in at the March 9th, 2026 evidentiary hearing and adopted both your pre-filed materials and responses to interrogatories submitted through that date at that time. Ms. Tebbets, Mr. Hurwitz, and Mr. Kolka, as part of your preparation for this docket, did you provide pre-filed written testimony and exhibits which were filed on March 16th, 2026 and were marked as Exhibit A supplemental, attachments 1 through 4, and exhibits F, F2, H, and I supplemental?
Yes.
Yes.
And do you have any updates or changes to this pre-filed testimony and exhibits not previously identified for the record?
No.
No.
And do you adopt your pre-filed direct testimony and exhibits as part of your sworn testimony in this case?
Yes.
Yes.
Mr. Hurwitz, is your mic on?
I said yes, though.
Thank you. Mr. Hurwitz, as part of your preparation for this docket, did you provide pre-filed written testimony and exhibits which were filed on May 26, 2026, and were marked as Exhibit A, March RAM application, supplemental TAC, and executive compensation, and attachments 1 through 3?
I did.
And do you have any updates or changes to your pre-filed direct testimony and exhibits not previously identified for the record?
I do not.
And do you adopt your pre-filed direct testimony as part of your sworn testimony in this case?
I do.
Mr. Hurwitz, Mr. Daniels, Ms. Chasse, Mr. Stanley, Ms. Miller, Mr. Hernandez, and Mr. Kolka. Did each of you sponsor or co-sponsor the responses and attachments provided by the company on March 16th, 2026 as part of the company's standard interrogatory filing, Exhibit 1 of which was supplemented on May 29th, 2026?
Yes.
Yes.
And do you have any updates or changes to your responses to the company's standard interrogatory filing not previously identified for the record?
No.
No.
Do you adopt your responses to the company's standard interrogatory filing as part of your testimony in this case?
Yes.
Yes.
And to Ms. Miller, Mr. Hernandez, Mr. Tarakani, Mr. Patel, Mr. Kolka, Mr. Hurwitz, Mr. Jessup, Mr. Daniels, Ms. Chasse, Mr. Stanley, and Mr. Rosa. Did each of you also sponsor or co-sponsor responses to interrogatories submitted in this proceeding following the March 9th, 2026 evidentiary hearing?
Yes.
Yes.
And do you have any changes or corrections to any of your interrogatory responses not previously identified for the record in an interrogatory response?
No.
And do you adopt your responses to interrogatories as part of your testimony in this proceeding?
Yes.
Yes.
And lastly, Mr. Jessup, for purposes of admission into the record, have you reviewed and do you adopt the standard interrogatory responses sponsored by Ms. April Thaberge in this proceeding?
I do.
Thank you. The panel is available for cross-examination.
Thank you very much. We will start with cross from authority staff.
Thank you, Mr. Chairman, Mr. Vice Chairman, Commissioners Beecher, Cheeseman, and Smith. Good morning. Good morning, all. My name is Russ Bowman. I'm a staff attorney here with the authority, and I have some questions that will be in the following areas for planning purposes. We'll talk about locational marginal pricing and the power purchase agreements in the context of the recently initiated two-pronged test for potential interim NBFMCC rate adjustments. Then I have personnel labor within the NBFMCC, executive compensation amortization, and then a few questions on the company's interrogatory responses concerning the TAC. Starting with the LMPs and PPAs. Based on the company's compliance filing on May 13th, specifically attachment 2, it looks like UI is indicating that since the interim decision, there's a deviation of approximately 1.5 million additional net costs expected in calendar year 2026 compared to what is currently in rates. Is that correct?
Good morning, John Stanley. The 1.5 is actually a decrease of the net credit that would be applied if it was to be applied. So yes, just to make sure that the signs are right, it's a decrease in the credit.
Okay, thank you. And that same attachment indicated that that 1.5 million constitutes approximately 1.6% deviation in the NBFMCC, and that's cell I-5, I think.
That's correct.
Okay, so if I'm doing the math correctly, and maybe you can check me on this, the deviation would have to be greater than 9.375 million to trigger the 10% NBFMCC deviation prong of the two-prong test.
That's correct.
Okay, so then turning to the other prong of the test, what would the approximate cost deviation have to be to trigger the 1% whole bill impact?
1 second, please.
Given that for the months which we've performed this two-step analysis, we haven't triggered the first step, I don't know that we have an official answer to the second step to share at this time.
Is it something that could be easily produced as a read-in?
I don't know about a read-in, but I'm sure that it could be easily calculated.
Okay, I'd like to request a late file on that if possible, Mr. Chair.
Sure, that could be late file one, and it would be are you asking for just the total bill impact of the adjusted implied MBFMCC rate on this exhibit?
Yes, sir. Just because it's the first time dealing with the two-prong test, we're trying to get a sense of how it would work out and what those figures actually look like in practice.
Just to say your question back to you to make sure that I understood, you asked about what would the dollar value have to be to trigger the first prong, the 10% of the MBFMCC revenue requirement. And this second question is, what would the dollar value have to be to trigger the second prong, about 1% of total bill?
I think we answered the first one. It's the second one that we didn't have an answer on.
I got you.
Okay, that'll be late file one.
And the reference for that is the compliance filing of May 13th, attachment 2.
Got it. Thank you.
So just a general question, understanding that the company will be filing updates June, July, and August 13th in advance of the final decision. Are there any major concerns or things you're seeing within PPA costs that aren't built into rates that we should be focused on?
The only thing that's coming to mind for us is a PPA with respect to Revolution Wind. We talked to some extent about that in our discovery, and we think that the approach we've taken is reasonable, and we've explained why we think the approach we've taken is reasonable. And also, it doesn't have the largest effect on the results of our analysis, but I think if you were to pick one key consideration based on what we're knowledgeable about sitting here today, it would be that one. Have we treated that in a manner that comports with what Pura would expect, and are any changes to our calculations thereto required?
Okay. Is the company proposing any changes related to that, or just noting, since I asked the question, it's something you're tracking?
Just noting, since you asked the question, the approach that's embedded within these numbers, I think it's the confidential attachment 1, which I won't speak to now, but we think that's reasonable, and we're sticking to what we've done. But since you asked the question, that's the thing that comes to mind for us.
Fair enough. Thank you. So then we'll turn to personnel labor in the NBFMCC. Specifically, the company's response to Interog CAE 49.
Just a moment. I am there.
To make sure I understand it, CA 49 seems to indicate that clean energy program personnel charge less than 100% of their time directly to the clean energy programs in order to code what appears to be the administrative component of their time to wholesale power non-bypassable FMCC admin within the NBFMCC. Is that correct?
Just a moment.
And just while the witnesses confer, we've brought Ms. Miller up to the table, who sponsored this interrogatory.
Thank you for the patience. What we're saying here is that in years past, there was time charged to the line that you quoted, wholesale power non-bypassable FMCC admin. However, as described at the bottom of page 1 of this response, in response to some commentary from the OCC last year, that those particular individuals changed how they were charging their time to more specifically reflect the activities they were working on. And that's described to some extent in this response.
Right. And I see that's line 79, 110, and 126 of Exhibit F, page 3. Is that correct?
Correct.
And those appear to correspond to a similarly titled wholesale power non-bypassable FMCC admin line, and then also non-service pension OPEB costs, and thirdly, executive compensation reconciliation. Is that correct?
I'd take that subject to check. I'm happy to validate those labels if you'd like to bear with me.
No, subject to check is fine. I just want to make sure that that is the increased granularity that the company intended.
That sounds right, yes.
Okay, and then just to confirm, are there any other line items within the NBFMCC that are being direct charged clean energy and grid modernization personnel labor costs beyond those we've just discussed?
One moment.
Good morning, Christy Prescott. So just could you just restate the question? Just want to make sure.
So are there other line items where personnel are direct charging costs beyond those that we just discussed?
Sure. The answer is yes. And so I'll just go back one moment in terms of the wholesale power contracts labor. Traditionally and previously in this docket, the wholesale power team who prior to the clean energy equitable modern grid dockets being added into the RAM and the non-bypassable FMCC, traditionally the labor had been being performed and recovered for administering the LREC-ZREC program or the NRES program or shared clean energy. And so that was all bucketed into the wholesale power admin line item. And so that work is done by a number of professionals for the company. But as a result, and as we mentioned, as a request from the OCC, specifically, there was a line item added to record the labor specifically for NRES or SCEF or LREC-ZREC this year. So that's why you're seeing the wholesale power labor amount go down. And then some of that is added into those new line items where we'll have a dash for 2024 because that's a new line item. That's why it's dashed. If you look at Exhibit F, page 2, you'll see a dash. And so that is answering in response to NRES and shared clean energy and LREC-ZREC. In addition, there are other line items in the non-bypassable FMCC to respond to clean and equitable modern grid labor that's outside of the traditional work that the wholesale power group did. And I can point to those where you'll see them. They are line 88, 89, and 90 of Exhibit F, page 3. And also, sorry, because that one is one we just talked about. That's NRES, SCEF. There's also line 121, which is the Shared Clean Energy Program Administration for the subscriber credit. That's work that was not done by wholesale power, but yet another area of our company to administer the subscriber credit associated with shared clean energy. And then there's also two more line items I wanted to point your attention to is line 169, Pura Innovation Pilots Internal Labor. That's for the Innovative Energy Solutions Program. That's line 169. And then also there are some labor included in line 195, UI EV, which would be electric vehicles labor. Oh, and excuse me, I apologize. Thank you, Mrs. Miller. Ms. Miller is, I think I did 88, 89, and 90. Yep.
Line 88 was what you said there at the end. I'm sorry.
I'm sorry. I said, I think I had already directed you to 88, 89, and 90.
Yep.
Yep. Thank you.
Okay, thank you. That's very helpful. Just wanted to make sure that it was not just the ones that were called out in the interrog
Yeah.
response, but additional.
I appreciate your question. Hence the, we looked closer at that just to make anticipatory for that.
Okay.
Thank you.
Thank you very much. Okay. All right, then we'll move on to CAE 69. More of a conceptual question The company stated at the end of Part A of the response that RAM personnel labor is subject to more annual variability than personnel labor housed in the distribution rates. So why does the company believe that to be the case? Just hoping you can expound on that a little bit.
Yeah, that's a fair question. And what we were thinking as we wrote this response was, there's pros and cons to continuing to carve out RAM labor and include it through the RAM. And if there's an employee who is an employee of UI directly, UI will bear the full cost of that employee. There's some minor exceptions. Maybe they charge a few hours to their affiliates, but UI is going to bear at least 80% of the cost of that affiliate, of that employee, and often the 100%. If that employee devotes some of their time to a particular RAM initiative, there's an argument because of the principle of cost causation that maybe that portion of their time should be carved out, but that hasn't been the approach taken in UI's last two rate cases, and conceptually it seems like little gain for a lot of administrative burden. However, if an employee is an affiliate of, if an employee is an employee of an affiliate of UI, only that portion of their time that is devoted to the RAM will be borne by UI through direct charging. So if an employee spends 10% of their time one year working on a RAM initiative and 20% of their time the next year, well, now UI's costs truly have changed in a way that it's not just an administrative exercise choosing which bucket to put the cost in. Now you run the risk of rates that are more than or less than sufficient to cover UI's costs. So what we talked about here, and I think at least one or two other discovery responses, was we'd recommend continuing with the status quo approach, whereby in base rate proceedings, UI's headcount, that UI's payroll expense is recalculated based on its actual headcount as of a certain point in time, with adjustments for incremental FTEs as Pura deems appropriate. But payroll for UI's affiliates, we don't try to roll in incremental charges with the RAM, because that, the cost to UI can truly fluctuate more than the cost of an employee of UI, if that makes sense.
Understood. You would agree there are also fluctuations with cost and base rates though as well?
Could you give me a little bit more there? Base rates typically get set and then are, so-called sticky until the company's next rate case.
Right, but set and are immediately inaccurate as reality sets in.
That's not the intention when setting base distribution rates. The intention, I hope, is to set rates that reflect UI's expected costs in the rate year. Now, as a practical matter, that's a difficult exercise, but that absolutely should be the intention when base distribution rates are set. As we've seen over the last few years in the RAM, the types of programs reflected in the RAM, the requirements to implement those programs, those do vary a lot more than the requirements placed upon UI to provide base distribution service. And so we think it's appropriate to continue excluding the cost of RAM-specific labor from UI's affiliates when setting base rates, and instead include that fully through the RAM.
Okay, thank you, because I think that gets at the heart of it. Is it that variability that the company believes justifies the treatment, or is there a different standard we should be looking at?
It's the same standard in my view, and as a not lawyer, we should always be trying to set rates that comport with Connecticut General Statute 1619E, rates that are sufficient but no more than sufficient to cover the company's cost, including with respect to staffing levels. In the RAM, I think is evidence of the frequency of the variability. We have a full-blown requirement to file Exhibit F2 indicating incremental FTEs each year, and I think for each of the last few RAM years, we've come in with the small proposal each year, and the number of FTEs recording time to the RAM has changed as a result of that. So I do think there is variability in that regard, and I do think the current approach remains appropriate largely for that reason.
Okay, appreciate the conversation.
Thank you for the question.
Also in the company's response to CA 69, company indicated there may be minor labor cost allocation differences between RAM and base distribution rates, so kind of variation on the theme here. What does the company view as minor in this context?
I don't know that there was a particular definition of minor that I had in mind as I wrote it, but just to expand upon that a little bit. I think we have 4 UI level FTEs with time that gets charged to the RAM. And in both the MBFMCC and base distribution rates, steps are taken to ensure that rates are designed in a way that comports with the principle of cost causation. But without having specifically studied the nature of the cost allocation studies underlying both of those rate setting proceedings, it seemed to me that there could be differences in how costs get assigned between the rates for those 4 FTEs in base distribution rates as compared to the RAM. But considering the totality of the administrative implications of a change and the relatively minor nature of 4 FTEs as compared to UI's total headcount, which is on the order of 600 to 700 FTEs, that felt minor to us, and it felt sufficiently minor that the any marginal benefit in terms of better comporting with the principle of cost causation was outweighed by the administrative burden of making a change.
Understood. Appreciate the further explanation.
Thank you for the question.
Turning a little to labor allocation then. According to the company's supplemental response to CAE 45, was filed, I think, on Friday, 2 additional UI level FTEs inadvertently allocated a portion of their time to NBF-MCC in 2025, despite their labor being included in base distribution rates. Can the company explain how the miscalculation occurred and what, if any, controls exist to prevent it?
That's a great question. So it wasn't so much a miscalculation as a misrecording of time. We explained, I think in at least one data request response, how we have an internal order structure where employees charge their time to a particular internal order, and then we pick up the cost of certain MBFMCC specific orders when we come to you proposing an MBFMCC rate. And as we were preparing for this hearing, we reviewed all of the time charging that was recorded to the orders picked up in the MBFMCC and identified these 2 erroneous employees who I think just hadn't fully appreciated which order was the right one for them. So given that this was identified shortly before the hearing, we're contemplating the exact sequence of steps we want to take to make sure that this doesn't happen again. But we identified it as we prepared for hearing and intend to supplement that response again with the dollar value implication of this change in the next couple of days, ideally.
So just to summarize that's it. Basically an individual employee's recording error on how they filled it out.
That's right.
Okay.
That's right.
Then turning to the company's response to CAE 70, attachment 2, page 1.
I am there.
So there are 5 positions listed in the attachment. Just wondering if these positions were included within the approved FTE for base distribution rates as approved in the company's last rate case, the 24-1004.
One of them was subject to check. I believe it was the regulatory project manager. Our supplemental response to CAE 45, not the one that was filed on Friday, but the previous one, talked about this to some extent. While preparing the original response to that question, we had identified 1 erroneous person. I think the original attachment to CAE 45 had listed 20 positions. And we talked about removing the time of one of them, a regulatory project manager, and the supplemental testimony that we filed on March 16th quantified the effect of that change. But in our view, the other 4 positions were not included in base distribution rates in Docket 24-1004, and accordingly, we think it remains appropriate for these people to have their time reflected in the RAM for now.
Okay, thank you. Go next to executive compensation amortization, and this is CAE 50.
I am there. Thank you.
Just want to make sure I'm following some of the dates here. In the narrative of the second paragraph, UI stated that UI began to amortize executive compensation reconciliation straight line basis over the period July 1st, 2024 to April 30th, 2025, correct?
Correct. And your question is, well, I'll say correct and see where you're taking us.
Yeah, I think so. Looking at attachment 1, page 2 of 50, it looks like they're booked from July 2025 to April 30th, 2026. I'm just looking for clarity on the,
Yeah, no, I'm so sorry because I was asked upon direct if I had any corrections, and I had talked about this some weeks ago with someone on staff. That should be July 31st, 2024 through April 30th, 2025 in the attachment, page 2.
okay, so the narrative is correct, as are the lines below the month-by-month accounting.
Correct. In the 12 months that follow, my recollection is Pura approved a similar amount of executive compensation, but it went through the RDM. So this attachment is, but for the date labels in Excel column B, page 2, this attachment is correct.
Okay. So then the bigger picture question is there anything about the filings that would mean that the proxies that were used to set current RAM rates are incorrect?
That's a great question and something talked about in the, I forget the date, but the most recent supplemental testimony that we submitted regarding the TAC and executive compensation. What is reflected in the MBFMCC rate currently in effect as approved by Pura in the interim decision is $139,858. Now that we have the results of UI's performance in the most recent year based on the executive compensation performance metrics established by Pura and Docket 24-1004, our position is that we are now entitled to the full amount of executive compensation, and an upward adjustment is required. And I tried to lay that out in the supplemental testimony. But to your question, given that there is some amount in the MBFMCC already baked in, the appropriate adjustment is not to increase the MBFMCC rate by the full amount of executive compensation to which we're entitled, but only the difference between that full amount and what was already embedded in rates.
Understood. Just wanted to clarify that we're all on the same page with that.
That's a great question. Thank you.
All right, with that, then we'll turn to the TAC and specifically company's response to CA 56.
Just a moment. I am there.
So understanding that a rate in this context is a formula reflected FERC. Is there anywhere in the exhibits that the company provided that shows the actual approved RNS and 12C rates in terms of actual figures used for the calculation?
Could you give me a little more? What do you mean by actual figures used for the calculation?
Well, if it were a spreadsheet that would have a rate, we would have a specific number that we could use and check the math of the calculation of the known and measurable adjustment. We're just trying to figure out
Oh, the
where we can do that here.
Okay, I had not appreciated the known and measurable link. Just one moment. So with respect to the known and measurable adjustment specifically, I don't think we officially proposed a known and measurable adjustment, but in our known and measurable testimony, we did provide the calculations of what we think the known and measurable adjustment would be if one were to be adopted. And in our view, the net result was small enough that it didn't make sense because the effect of what we calculated was limited to just the impact of the rate change, and it's likely to be inaccurate because load will also fluctuate, and it felt just, so small that it was false precision this year. But that aside, I've pulled up Exhibit G to our January 15th known and measurable filing. And I've gone first to page 1, which relates to RNS expense. And you can see the forward-looking RNS rate reflected therein is $15.3128 per KW month. You multiply that by 12 and you get the dollar per KW year rate that is the actual RNS rate. And I've just done that quickly here. I see $183.75. I don't know that we've provided this exact attachment on the record in this case. We would be happy to do so via late file, but you can see that same rate reflected in the public posting on June 15th that ISO New England does regarding the RNS rate, and it's later filed with FERC on July 31st, in this case 2025. You can see that same exact rate reflected in Attachment 1, Schedule 9. It's just a very simple page that shows the sum total of all of the regional transmission owners' revenue requirements. It divides it by the average 12-month coincident peak for the region, and you get the rate that I just said. I don't recall this exact document is on the record because I had missed the known and measurable connection, but we would be happy to provide it via late file.
Yeah, just so we can ensure that it's in this record, even though it may be publicly available elsewhere, that would be great.
Of course. And there should be a similar, I just focused on RNS rate because it's the simplest, but there should be a similar concept for Schedule 12C as well.
Okay, if we could have both as part of the same late file, please.
That would be no problem.
That'll be, excuse me, that'll be late file 2. And someone help me with the narrative of what exactly are we asking you to file the public documentation from ISO New England or the known and measurable adjustment?
I think you could combine the two things that you just said, the publicly available documentation from an ISO New England that corroborates our known and measurable adjustment,
Okay.
assuming I understood correctly.
Yes, thank you.
And that's just for, is that for RNS or LNS and 12C?
RNS and 12C.
Okay. We don't need it for LNS?
Oh,
There won't be a similar document for LNS that will be UI specific.
Right, okay, gotcha. That'll be late file 2.
thank you. So next, I'd like to turn to interog response CA 60, which also references CA 68 within it.
Just a moment. I am there.
Okay, so bear with me. I'm going to have to step through a number of things for this one. In Section A of the company's response to CA 60, company references CA 68 in response to a request for uncollectible account expenses that support the increase in the LNS expense for 2025 within the TAC. When looking at CA 68 Attachment 1, specifically on row 14, that shows the write-offs assigned to transmission, it looks like in 2024, the total costs were approximately $1.383 million. And that's cell G14. And in 2025, it was $2.208 million, cell C14. So that's a difference of approximately $800,000. Is that what you're seeing?
I see approximately 825,000.
Fair enough. The total year-over-year increase to the LNS expense in the TAC looked closer to be $4.35 million. That's cell F14 of the company's March 16th compliance from order number 8 in 220908, Exhibit 1.
I'm sorry, could you hit me with the reference again?
Yep. So this is the March 16th compliance filing. And there were 2 compliance filings that date. It's the one for order 8 from 220908.
And do you happen to have the little letter next to the order rate? I recall what you're talking about. I just don't recall the letter, unfortunately.
I'm sorry.
There are several standard interrogatories
I got you.
denoted by letter.
So this is, I have it as Exhibit 1, and then there,
Oh, okay. One second. I am there.
and there's a TAC tab.
Yep.
So that looks like the increase year over year was 4.35 million.
Yeah, and I'll just say a few words and
Yeah.
see what follow-up questions you have. UI's transmission revenue requirement, not its RNS specific revenue requirement or LNS specific revenue requirement, but its overall transmission revenue requirement is allocated almost entirely to the region, more than 90% to the region. Only a very small sliver of its transmission revenue requirement is actually allocated to even the state of Connecticut, but even further UI customers. My recollection is the LNS percentage is 2% and the Schedule 12C percentage is not that much higher. One of the few things that is allocated in UI's transmission revenue requirement just to state of Connecticut customers is customer accounts expenses. That dates back to a 2008 FERC order that I'm sure we've talked about at least once on the record in this case, although I don't recall where. But that's customer accounts expenses as a whole, not just uncollectible expenses. Customer accounts expenses are the string of FERC accounts, I want to say, going from 901 to 916, although, all right, I've got a nod from my SME here. Uncollectible accounts are part of that. That's 904, but they're not the only one. But there are many, what I'll call relatively smaller variances that have added up to this larger one. Uncollectible expense is one. The remaining elements of customer accounts expense is another. There's some increase in UI's transmission rate base, which gets allocated in small part to Connecticut customers. There's lower revenue credits also play a factor, but we have a relatively lengthy explanation here because there are a number of things that contributed to this variance, but we led with what was the largest one, customer accounts expense, and then the next sentence talks about the largest individual component of that, which is uncollectible expense, but there are other elements of customer accounts expenses as well.
Okay, we were just trying to rectify the $800,000 amount versus a $4.3 million amount. I think you've explained that that may be the largest of a number of things.
That's exactly right. And I'll even further add that in the supplemental testimony we filed last week, we included, I think for the first time since I've been here for the last 4 or 5 years, a downward FERC Form 1 true up. And this year it was a little shy of $1 million, maybe $900,000 or so. The exact number was in my testimony. But the reason for that is the allocation to Connecticut shrunk even further. I said a minute ago how Connecticut is allocated only a very small portion of UI's transmission revenue requirement. The proportion of that decreased even further in 2025. We determined once we completed the PTF study this year, because most of the plant investments that UI completed this year being calendar year 2025, were RNS plant investments, and it's basically a gross plant allocator that dictates what portion of the revenue requirement goes from UI to the region, UI to local, and UI to Schedule 12C.
Okay, thank you. Very helpful. Speaking of FERC, let's look at CA 61.
I am there.
All right, so understand the company's position on the point. The question is more broad in regards to any potential funds that could be due in the future to UI customers as a result of FERC's opinion number 594. Has UI ever dealt with a major FERC-induced reconciliation such as this previously?
Certainly nothing on this order of magnitude. This is a 100 basis point change in the base ROE covering a period of 15 years because of FERC's legal error. There have been certainly true ups in the past. The current formula rate process intrinsically involves a true up. There was some rate adjustments stemming from ROE changes 10 to 15 years ago, when the base ROE went from 11.14 to 10.57. I believe I got another nod from my SME, but that covered a period of 15 months, not 15 years. So something to this scale with this level of financial consequence covering this period of years, to my knowledge, is unprecedented.
Okay.
And that's part of why some of the New England transmission owners sought a stay of this for the courts.
Understood. Thank you. Mr. Chair, that's all the questions I had. I know Mr. Arpin has some as well. Mr. White.
Thanks. Can I just ask one really quick follow-up on that topic? I was just curious how, I understand there's an appeal and who knows what's going to happen ultimately, but I was just curious, like from a purely rate-making point of view from where we sit here, my guess of sort of what would happen should the company have to pay some amount pursuant to that FERC order, would it work kind of like how we've been working with like the bond revenue for the NBFM, sorry, the EV and uncollectible costs, meaning like from an accounting perspective, would it look essentially like a sudden influx, I guess, of would it look like revenue from your transmission segment to the distribution segment in the form of whatever payment the company would have to make? That would be come in like a single month, and that would kind of offset whatever, presumably substantially make a change to the over or under collection there, and it was kind of flow through the RAM in a similar way. Or you understand what I mean, Mr. Hurwitz?
I do. I'm just reflecting. I'll caveat my answer by starting with I'm not certain. And I'll also say at the outset that I think the timing of this is also uncertain, whether it would be 1 month or a series of months. I think conceptually there would be similarities to state bond funding. There would be a relatively large dollar amount in a relatively small amount of time available to customers. But I think there are at least two complexities to that. One is the vast majority of the amount that UI owes will not go to UI customers, but rather to the region for the same reason I discussed with Attorney Bowman a minute ago. But the flip side of that is also that UI customers would receive a large amount of money from companies other than UI. And that would be reflected as a reduction to the RNS expense that UI customers have borne. That's the lion's share of our proposed tax rate each year. And then there would, in addition, be LNS implications. But one of the complicating factors here, and one of the reasons why we don't have an estimate of what the amount due to UI will be, is for most of this retroactive refund period, UI's transmission rates, like the transmission rates of at least many of the other regional transition owners, were calculated using what I'll call RNS revenue crediting. In other words, the LNS revenue requirement was calculated by beginning with UI's total revenue requirement for transmission and then subtracting the RNS revenues that UI received, or crediting RNS revenues. And the LNS revenue requirement was just the difference between those things. Over this 15-year period, I understand that there are differing approaches being contemplated. I don't know that anything has been officially decided or publicly commented on by the parties yet, but I understand there's contemplation of sometimes it would be a rate change, sometimes it would be a simple dollar value refund, and that matters not a lot to the region as a whole, but it's going to matter a lot to UI because of the relatively small fraction of UI's revenue requirement that goes to LNS customers. Those two things work together to make this a very difficult calculation. It's one that we'd really like to get right. But I think there are some, to your question, analogies to state bond funding in that if and when these refunds occur and are known, there will be a large dollar amount available to UI customers in a relatively small amount of time.
Yeah, I guess what I've been trying to wrap my head around is, and no one, I don't think anyone knows the answer to this, but the kind of roughshod way, as you know, that we've been dealing with the state bond funding is we've all been optimistically assuming that the money is going to be available in the coming rate period and making a known and measurable adjustment to account for that in the shared goal of kind of smoothing out the effect, right? I don't know if that's possible here. I think that, well, would you agree that whether that's possible here is going to be entirely dependent on the timing of when we all know what's happening? Do you think that's a fair assessment?
I do. We paid a lot of attention to this question, as I'm sure you can imagine, and I think some of the factors that were influenced the approach we ultimately recommended are one, we don't think this meets the known and measurable standard at this time, and we think it doesn't meet the known and measurable standard for at least 3 reasons. First is we just don't have the calculation. We've been working very hard to calculate by year the correct amount of UI refund that is owed to the region, but it would not be possible for us, in my estimation, to calculate the refund that is owed to UI from the region because we don't have a breakdown of the amounts owed by other transmission owners by year. There's a publicly cited figure of $1.5 billion for the whole period, but the share of that UI is entitled to will differ by year, and that covers all of the years, and we don't have a breakdown by year at this time. Second, like you described, we don't know when the refund will occur. We had asked for a 19-month extension. FERC had granted a 13-month one, such that refunds are now due in by May 20th, 2027. And 1 or 2 business days before we filed the response to CAE 61, FERC actually filed something with the DC Circuit Court clarifying that transmission owners are under no obligation to pay any refund by May 20th or before May 20th, 2027. And then third, it wasn't clear to us that it will occur at all, given the legal challenges. I'm not a lawyer, so I won't opine on that much further. But for all of those reasons, it felt like it didn't meet the known and measurable threshold. And then for one additional one, which I think we included at the end of our narrative response to CAE 61, is this particular year, the RAM is already producing a very large credit to customers. Our primary concern is getting the rates right, and we don't mean to point to the decrease as, oh, this isn't important, because it absolutely is. But given that there is already a very large decrease to customers as a result of this year's RAM, it felt to us, considering that and the difficulties with respect to known and measurable that I just talked about, it felt more appropriate to wait until we have the correct, more known, more measurable amount due to UI customers. And if and when that day comes, of course, reflected in the RAM, but it felt like that day wasn't today.
Thanks, understood. And I really wasn't reaching for, in my mind, I was not thinking like, oh, we should make it known and measurable. I was just curious your thoughts on, my concern is this kind of coming through as what will feel like a sudden substantial, with the information we have now, a substantial over recovery that we're not going to be able to kind of soften ahead of time at all. And that might feel really great at the time, but I'm worried about what happens at the other end of that, obviously. But I think this is a discussion I'm sure we'll be having in some future proceeding when we deal with this, with whatever this looks like. But so I was just curious.
No, and you gave me a window to talk, so I was going to take it. I didn't read your question any particular way, but I think that's right. If we had better insight into the known and measurable amount due to UI at this time, we'd probably be proposing something, but we don't. I think I'd anticipate this being a subject of much discussion in next year's RAM. I don't know that this will be fully adjudicated by January 15th, the time our next known and measurable adjustment is decided, but we'll certainly have more information at that time. Many more events will have occurred, more calculations will have been done. There will be, feedback from the courts and FERC and other things most likely by that time. So I do anticipate this being a subject of much discussion, particularly given the dollar values at stake here. But I think it's, as we sit here today, just a little bit premature to try to make a change, because the risk would be you try to get out in front of this, you try to incorporate some level of downward adjustment now, and then what if it doesn't come to pass? You have to unwind that, and that creates its own kind of set of issues. So in light of all of the things that I said, the challenges with respect to known and measurable, the FERC's filing with the court, the fact that the RAM is already producing a substantial rate decrease for customers now, the most appropriate path in our view is the one laid out in our response to CA 61.
Thank you. Sorry, Mr. Arpin, you can go ahead.
So thank you, commissioners. So good morning. My name is Christopher Arpin, and my questions will primarily relate to the company's add-on netting project within the NBFMCC, costs associated with the SBC, and a couple of questions on personnel cost. So I'll first turn to the add-on netting project within the NBFMCC, specifically Interog CAE 52. Just give it a moment here. So the company originally estimated in docket number 230803 that add-on netting project would cost approximately $300,000. However, final costs are now approximately $1.3 million. So in response to interrogatory CAE 52, the company stated it did not conduct a competitive RFP for the project due to concerns that doing so would delay completion of the project timeline established by PURA. However, upon review of motion number 23, ruling 2, and docket number 230803, the authority did not establish a hard deadline for completion of the add-on netting project. So could the company please identify where PURA required them to complete the project by a specified date, such that this would not warrant a competitive RFP for the project?
Katarina Miller. Thank you for the question. I really appreciate it. As the company responded to CAE 52, the cost was estimated in Order 24, docket 230803, as NRES for $650,000 for add-on netting and RS $378,000. The reference that you are making for $1.3 million, I believe that you have mentioned, can you please provide detail? Because as the company responded to CAE 53, in attachment 1, it provides for add-on netting category for RS is $181,000, $837.50. And then for add-on NRES is $369,827.20.
1 moment, please. So just to clarify, Ms. Miller, so looking back at the original motion and docket number 230803, I see a different reference to a specific cost item that the authority had approved. Specifically, UI had estimated that the cost would be 300,000 and CA 13 in that proceeding. So I was wondering where you're getting this alternative cost estimate from. I believe you mentioned 650 or something to that effect.
Thank you. I appreciate that question. So on March 15, 2024, CLMP, also known as Eversource, and UI filed in docket 230803, a motion number 23. In that motion, and also PIRA requested in their approved order number 24, which was a plan to allow for a new add-on system to enroll under the non-residential and residential programs. Motion number 23 was granted in part and denied in part. Additionally, we have filed CAE 13 and CAE 14, which was based again on the company's estimate before the vendor actually was engaged, and we have received the estimate from based on the scope and requirements to implement the enhancement and implementation of add-on netting. Motion number 23 and motion number 28 was approved by Connecticut PIRA by the authority on June 26, 2024. The motion that I have referenced earlier was in order number 24, again, docket 230803, and NRES was stated as a $650,000, and RS was stated as approximately $378,000.
To clarify, I believe we're talking about different motions here. So there was a second motion to 23 that was issued on May 23rd, 2024, in which the authority directed UI to implement an alternative plan. And the cost cited in that motion is $200,000, which is lower than the cost in the original motion, which I believe was partly denied. So I was wondering if you could just clarify just one more time.
Certainly. And again, yes, there was a motion that you have stated earlier. However, as stated also in that response, that was just an estimated cost. It was based on one rate. Please note that we have multiple rates that had to be implemented. This was for implementation of billing system. The company, throughout the estimate and entire work that was provided by the vendor, try to actually save ratepayers money by combining 4 different projects, which is MFAH, add-on netting for NRES, and add-on netting for RS, and also SEM Phase 2, to save and to eliminate any of the redundancies.
Thank you. And in reference to your earlier question, Ms. Miller, about the cost, I was referring to Exhibit A with a note of measurable filing, and specifically pages 22 and 26, which reference, I believe, different cost numbers than what you had referenced earlier. Specifically going back to page 22, it looks like 669,000, I believe, was the add-on cost for ROs and multifamily affordable housing, and then page 26 referenced the remaining amount, which is where the $1.3 million came from. Just to get back to your earlier question here, but to move on here, so in that same ruling, it looked like, and in that interrog response, I should say, it looked like the requirements gathering phase did not end until April 2025, which was approximately 11 months later from when the ruling was issued in May of 2024. So I was wondering if you could please explain the primary factors that contributed to the length of the requirements gathering phase for this project. Specifically, given the duration of this phase, could you please explain why the company determined it did not have sufficient time to conduct a competitive RFP for the project?
Thank you for the patience, Mr. Arpin. I'm going to give this a whirl and then invite my colleagues to add to the extent they'd see fit. And I'll also lead off by saying there's been a lot of citations thrown around. We would be happy to take a late file just to lay out our citations and what we're saying in more detail to the extent that would be helpful. But
I think that would be helpful, yes.
That'll be late file 3.
but I'll take a crack at this now since we've just talked about it and you've asked the question, and we may have some kernels of insight to offer. Broadly, this took a while because one, it relates to the billing system and you want to get the bills right, full stop. Second, this project, as we've pursued it, involved 4 components, and I'll let my more technical friends here talk about the specific details of all 4 rather than try to muddle through it on my own. But the original estimates provided in 230803 that you're discussing related to doing just one component. And for reasons that my colleague has to some extent already touched on, we thought it would be more efficient, more appropriate, more timely to do all 4 together. You can't do multiple things in the billing system at the same time, because for each individual change, they try to implement it, test it, make sure that they got it right. And if you're doing that testing while something else is happening in the background, that's a recipe for error. So I think the basic reason why the costs that you're seeing today are higher than the estimates in that other docket are because what we've done represents 4 things together, and the original estimate represents just 1. But I know there have been a lot of citations, a lot of numbers thrown around. We'll address this late file and try to lay that out a little bit more fully and a little bit more clearly for you. But before I pause to see if that was responsive, I'll see if my colleagues have anything they'd like to add beyond my response here.
Thank you, Mr. Jessup. I agree with the statements stated earlier, and there are, again, I would like to mention that there are multiple actually components that are part of this project. We have mentioned MFAH, we have mentioned add-on netting. Just docket 230802 has, just by looking at it, approximately 6 additional changes to the NNRIS program. 230803 add-on netting portal interconnection report, rec pay buyback, school solar, checklist integration. So we did have multiple requirements that actually have been implemented within all of these projects for the NRES and RS program. I do also want to mention that because it's an add-on project, it also affects not just SAP billing, but it also affects workflow. It affects other requirements and other departments and processes that are being implemented. And it also affects the legacy implemented already programs such as LREC, ZREC, for instance, that have been already automated, but now add-on system might have been required for the customer under the NRES program. So there are multiple components that have been enhanced and developed during these phases.
Thank you for those responses. So I have another question on this topic here. So I noticed in CA 52, you had mentioned using a legacy vendor originally selected in 2018 rather than an RFP. So at what point during the implementation of this project did the company formally commit to that approach? And could you just explain a little more the rationale behind that?
Certainly. So as I have stated, as the company stated in CAE 52, and I believe it was also CAE 53, when it comes to implementation of the billing system and any enhancement or any changes, it requires an expertise and high level of expertise, and not really many vendors are familiar with that. In addition to that, according to PRS issued final decision, order number 22, the company was required to complete the project by 1/1/2026. Because of the timeline and as provided in these responses, if the company went for competitive solicitation, it takes approximately 6 to 9 months to complete a solicitation, and that does not include the vendor familiarize itself with the SAP system. This vendor that we have hired has high level familiarity, actually performed and completed successfully the phase 1 of NRES implementation from the beginning of the program. Those enhancements to the system, including BIOL, netting, compensation, all of the implementation of the rates were actually completed in a similar fashion and with this vendor. And so the vendor was very familiar with the process and the system itself, the customer system.
I have a couple of follow-up questions on that. I think the first one is, you had mentioned that there not being enough time here, but I noticed that the original motion was issued in May of 2024, I believe, and the order deadline that you cited was January 2026, and you had mentioned, 6 months for an RFP. So could you just explain a little more about why there wouldn't have been enough time, given, that sequence of events?
Certainly, there was excuse me. You want to?
Thanks, Mr. Arpin, for the questions. I just want to make sure you had just asked us about why, in terms of timing, if there was time to run an RFP, why we would not have continued to use to look for another vendor?
Correct. Yeah. Why you would not have used an RFP, because I believe Ms. Miller just suggested that there wasn't enough time, but it seems to me that there was at least, 1.5 years from the order deadline that she had cited.
I think when we look at vendors for our billing system, from a corporate perspective, it is not advisable, nor is it in the company's opinion to be appropriate to have more than one vendor that is working in our billing system that isn't familiar with the system. And so because the vendor that is chosen for this work is the same vendor that does other billing system work, they have a level of familiarity that we need to ensure accuracy and knowledge and access to our system.
Thank you. So a follow-up on that. So since this vendor was selected in 2018, that was, of course, like 8 years ago, how can the company be sure that there aren't lower cost options, that could familiarize themselves with their billing system, given that it was such a long time ago?
That is a good question. I do not have the answer to that exactly at my fingertips, but I'm going to look to see if there's anyone from our IT organization that is here that I don't think we have. So we could take a late file on that, but I do know that there are service level agreements that we have with vendors, and I imagine, subject to check, I would imagine that there is a evaluation that's done with our vendors, but we can get you that information.
I think that would be helpful, yes, a late file exhibit, explaining why or whether there's lower cost options versus a 2018 legacy vendor.
Sure, that'll be late file 4. I have that as, would the best reference for that, Mr. Arpin, still be CA 52?
I believe so, yes.
So I have it as CA 50, reference CA 52, given the gap in time since the last work performed by the vendor, please explain whether lower cost options were explored, and if not, why not? Does that work?
I think so, yes.
Also, just for the record, for late file 3, which was the previous one, I think I'll ask Mr. Hurwitz, because I think, just going back in time 5 minutes, when you were talking, you suggested there were a lot of citations kind of floating around. It might be best to have a late file for this, I'll also ask Mr. Arpin. What I wrote down was, please provide citations for the assertion that Pura required a particular project timeline, as well as citations concerning estimates and evolution of costs for all aspects of the project. Does that capture what we were
I
looking
think so,
for?
yes.
Yeah, I agree.
Okay, thank you.
If I could just interrupt for one moment, Mr. Daniels here, to my left, would like to take an attempt to answer the question that I was unable to respond to in terms of late file 4. So would you mind if he tries that, and then we can see if his response is
That sounds good. Thank you.
sufficient? Thank you.
Yeah, I just want to try to provide a little bit more insight into what we're talking about here with understanding that we're still using a vendor that we contracted out to in 2018. And at the time that we did that, it was because we were having a major system upgrade. And although these projects that we're talking about here are very complex, they're essentially enhancements to our current billing system configuration. And it's very important that you keep continuity when you're doing that. Having a single vendor make the changes, keeping as many hands out of the cookie jar as possible. Also understanding that there's multiple projects going on at the same time. So to have multiple vendors doing multiple projects, that's just not feasible. And it's, a high potential for having billing and system issues. But we do when we go out to, as we did in 2018 with a major system upgrade, and as we'll be attempting in the upcoming years, we do at that time go out to an RFP for a system integrator, and which we'll be doing in the future, near future. Actually, it's underway. And at that point, we'll contract with a vendor to perform that billing system maintenance for that period, right? So I think that's what we're seeing here. So the idea that we would, for each one of these billing system enhancements, I'll agree that they're sometimes long projects, very complex projects. It's still dealing with our billing system that we have in place. So, it would be akin to, a car manufacturer maybe where if you have a very specific, say an Audi, you're going to bring your car to an Audi dealer. You're not going to bring it to a Chevy dealer, right? Because they don't know. They don't know Audi. So very similar. This is the system integrator that implemented our current version of SAP, and they're seeing the modifications through with obviously some small exceptions. And we're talking with these very complex, highly integrated projects. It's very important that you have continuity when you're doing that.
Okay, thank you for the response, Mr. Daniels. Just one moment, please.
Can I just jump in and ask, well, I'm going to leave it up to the company, but I'll throw this out there. If late file 4 would essentially say everything that was just testified, we probably don't need it anymore, but I would leave it to the company's option if you would like to file late file 4.
I was hoping to do that.
Sure. Okay, we'll keep late file 4 where it is. Thank you.
Testimony, sir.
I was hoping to say that my
Oh.
testimony would have served to say what we would have said in a late file.
Okay, thank you. Mr. Arbin, I don't know if you heard that, but what I said was, if what we get from late file 4 was essentially the same thing we just heard in testimony, I don't think we need late file 4 anymore. Does that you? Okay, so I'm going to cross out.
I agree with that. Yep.
Thank you.
So I have a couple more questions on this add-on netting project before moving to other topics. So I want to turn to CAE 53 now, attachment 1. Just give you a moment. So according to that response, CA 53 attachment 1, approximately 2,200 internal and external labor hours were associated with testing for the add-on netting project. Could you please describe the testing activities performed for this project and explain why the testing effort required this level of labor hours?
Can you please repeat the question? Because if I'm looking at CAE 53 and the column testing for add-on RS and add-on NRES, I am seeing on line 12 and line 25, 657 as an external total of actually on line 18, 719 for RS and on line 32, 732 testing hours.
Yes, I believe adding the three total numbers that you mentioned, 725 for multifamily affordable housing RS, 719 it looks like for add-on RS and add-on NRES, 732. I believe if you add up those three numbers, you should get to about 2,200.
Thank you. I appreciate that clarification. Again, when we speak about add-on project, MFAH is a separate component. It's a separate project. So is SAM Phase 2. So as far as RS, the total hours for testing were 719 hours for add-on netting. And for NRES, the total of testing hours were 732 hours. The other two are the projects, as we have stated in some of our interrogatories, including 52, 53. There are two additional projects that were combined with add-on netting because the company was seeking efficiencies and saving ratepayers money.
Yeah, I guess, get back to my original question, why was that level of testing hours required for this project? Because again, it looks like it was about 2,200 hours across all three.
So testing requires different components of testing. We have to do users testing, the functionality testing. There are different components of, excuse me.
Okay.
These requires the end user testing, departmental testing. Also for billing, for instance, billing department, we need to make sure that all of the functionality and all of the billing components are being reflected on a bill, or the workflow, for instance, that I have mentioned earlier, that it's being processed correctly, that none of the rates are being affected for any of the legacy programs as well.
Okay, thank you. One more question on this topic for the add-on netting. So in that same motion number 23, ruling 2, docket number 230803, it indicated that Eversource's costs for this project were $0. So in response to CA 54 asking about this, the company explained that even when billing platforms may be the same or substantially similar between EDCs, the underlying billing system configurations and requirements differ. So my question here is, could you please explain, at a high level, recognizing that you don't have detailed information regarding Eversource's systems, why UI would have incurred the level of cost it did to implement these changes, while another Connecticut EDC reportedly incurred no cost?
And while the witnesses confer, I think I'm going to object to the question, Chairman Wheel, to the extent that it asks UI's fact witnesses to opine about what may or may not be applicable to Eversource's IT systems.
I think I'll sustain the objection, but I think that as long as the question is specific to UI, I mean, I didn't take the question to be asking UI to explain why Eversource didn't cost anything, but I would agree that that's not presumably not within their knowledge anyway. So I guess I'll sustain, but ask you to ask the question again, specific to UI's knowledge of their own costs.
One moment, please. So I'm going to restate the question and just refer to what the company said in CA 54 about, EDCs and the underlying billing system configurations and requirements may differ as your explanation for why, costs may differ between EDCs. Could you just explain that a little more, what you meant by that in your interrog response?
So with respect to the other EDC's billing system, really can't speak to that, not familiar with it whatsoever. So wouldn't be able to articulate what might be differences between their system and our system. But what I can tell you is that these projects, because along with the other projects that we have going on, are highly integrated in all of our processes. These touch our matching payment programs, our hardship, segmentations for customers, as well as the discount rate, and other complex billing processes. What tends to drive cost is, fully understanding what we need to do to make the change, but also to make sure that we do proper regression testing to make sure that what we implemented didn't break something else. And that typically what drives cost in such a complex billing system.
Thank you for that response, Mr. Daniels. So now moving on to some other topics here. So specifically SBC related topics. So just give a moment for the appropriate witnesses to.
It may also be Mr. Daniels, just give us a moment.
I think I'm all set.
Okay, thank you. So my first question is relating to CA 63. I'll just give you a moment to pull it up.
I have it.
So according to the company's response to that interrogatory, the May 1st rate reduction may reduce LiDAR expenses due to lower energy costs. My question is, has the company quantified the expected reduction in LiDAR expenses associated with the May 1st rate change?
Was the question, has the company?
Yes.
Yeah, and I think in this response, which was submitted on May 19th, we hadn't yet had the time to do an analysis on, the impact of lighter costs with the May 1st rate change for the interim rate RAM decision.
Understood. I would ask that a late file exhibit please be filed with this relating to the estimated reduction in LiDAR expenses associated with the May 1st rate change and indicating whether the company expects that this impact will be material, as in like it would need to be changed for September 1st.
Sure.
Sure, that'll be late file 4.
Yeah, so I guess to clarify that, right? So understand that we're in an interim period here, right? Awaiting a final decision.
later on in this process. We, we could presumably give, you know, maybe the May and June reductions, and if the ask is for us to make the assumption that the current interim rate stays in place for the rest of the year, we can certainly do that. However, in terms of, you know, that could potentially have a material impact later on down the road if we were to make any material changes otherwhere, you know, for other parts of the rate mechanism.
I understand. Yes. Could you please go with that assumption and just clearly state, the caveat you mentioned here?
Okay, we can do that.
Well, can I throw out there, I'm fine with that myself, if Mr. Arpin is, but it might make sense, and perhaps the company might feel more comfortable, I don't know, the company has a recommended adjustment for September, right? So might it make sense for the company to model the expected LiDAR impact given the company's requested September adjustment for the rate period since May and then moving forward? And I agree, like we don't know yet what it will be, but that seems to be, wouldn't that sort of align across like the company's total filings?
Yeah, we can certainly take the late file. We were just highlighting that this isn't something that's yet known with perfect certainty. There's uncertainty both with respect to the rate and I think also with respect to the volumes that is actually consumed over the coming months. But we can, I think, absolutely put together some sort of calculation and caveat it as we see appropriate. And point well taken, Chairman Wheel, we can incorporate the recommended changes we've put forth as well.
Okay, thank you. I'll just leave that late file as, please provide any expected reduction in LiDAR costs associated with the May 1st rate change. And I'll also add and anticipated September adjustment. And then we can leave it to the company. Okay, thank you.
Yeah, we understand. Thank you.
Thank you. So moving on to CA 64.
I have that up.
So according to that response, the company has received and accepted a proposal from a legal collections firm to support the resumption of residential legal collections with contract execution expected by the second quarter of 2026. However, during the March RAM hearings, the company discussed challenges associated with identifying and procuring a residential legal collections firm. I was hoping that the company could please explain what changed between the March RAM hearings and the company's response to CA 64 that enabled the company to successfully identify and procure such a firm.
Market-wise, really nothing changed. In fact, we continued to seek out legal collections vendors willing to operate in the residential space and could not find them. However, a previous vendor to UI, which did perform residential legal consent to collections, had reached out to UI in response to the RFP, as well as looking to get our business back, and understanding that the market was not allowing us to, or we were not seeing firms that were willing to do this work. We engaged in conversations with that legal firm and are now working on finalizing a contract.
Thank you for that response. So moving on to a different topic. So regarding the bond funding authorized by Public Act 25-173 for portions of the SBC and FMCC rate components, does the company have any information regarding the status of the necessary authorizations from the State Bond Commission?
In terms of the state bond funding, we don't have any further information on the anticipated schedule. We're obviously monitoring the State Bond Commission agendas and looking for that. And we're just proceeding with the guidance that was given to us in the final interim decision.
Okay, thank you for the response, Ms. Prescott. So I have a couple final questions here relating to internal labor. So I'll just wait for the appropriate witnesses to appear.
I'll probably be taking the first crack, and depending on how specific your questions are, we can rearrange as needed.
Thank you. So my first question is relating to CA 71. So I'll just give you a moment to pull it up.
I am there.
So according to that response, employees whose salaries are recovered through base distribution rates may also have labor costs recovered through the RAM when they support projects traditionally recovered through a RAM component. Could you please explain how the company accounts for situations in which an employee whose salary is normally fully recovered through base distribution rates temporarily or unexpectedly charges time to a RAM relating project or program? Specifically, are there any corresponding reduction or true ups that occur within base distribution revenue to account when labor costs are shifted to RAM recovery from base distribution?
That's a great question, and I'll answer it in two parts. First, what happens if that employee is a UI employee? And then second, what happens if that employee is an affiliate of UI? If that employee is a UI employee, we will take that time out of the RAM. That's what has actually inspired the couple of corrections related to internal labor that we've talked about. Those employees were reflected in base distribution rates. They did legitimately work on things that relate to the RAM, and they charge their time accordingly. But in preparing for this hearing and in answering the CAE 45 request originally, we identified that some of that time had been charged to the RAM, was picked up in the RAM, and the approach we've put forth is we'll remove it. Because we've already fully recovered the cost of that employee through base distribution rates. And could there be a different way of approaching that? I'm sure, but that's what we've done. If the employee is an employee of an affiliate of UI, then that employee temporarily working on something RAM related, while those costs weren't picked up in base distribution rates previously, and the incremental time they spend supporting the RAM is legitimately an incremental cost to the company. And we have an internal order structure that we've talked about in, I think, at least one discovery response, and I'd be happy to talk about further if helpful. The employee will charge their time to the appropriate internal order, or if necessary, we'll create a new internal order for that employee, and the system will automatically calculate the cost of the time that they record to the RAM, and we will reflect it in our filings as appropriate.
Thank you for the response, Mr. Hurwitz. I have another question here. Actually, this is relating to capital projects, not internal labor, but could you please turn to CA 72?
I am there.
So according to that response, it seemed like the company supported both, one, continued recovery of emergent RAM-related capital projects through the RAM, and two, transferring such projects from the RAM into base distribution rates through a future rate case. Does the company have a preferred approach between these two recovery mechanisms? And if so, could you please explain?
Yeah, another great question. We weren't trying to describe two different approaches there, but rather one sort of stepped approach. So if there is, I'm just going to make up that we decide to wake up tomorrow and do 7-tier LIDR. I'm not suggesting that that would be appropriate, but just for hypothetical discussion purposes, if tomorrow there was an order that came out requiring us to pursue a 7-tier LIDR, well, it doesn't seem appropriate to me that that should require, in effect, the company to file a fully new rate case to recover the cost of that project. I could imagine that like 2-tier LIDR and 5-tier LIDR, there might be some discussion of the appropriate cost recovery mechanism for the cost of that project at the time the order is issued. And it seems to me that the cost of that project would be appropriate to reflect in the SBC. So I would think step one, once we've put that project in service, reflect the cost, the revenue requirement of that project, not the full cost, but the revenue requirement of that project in the SBC, so that the company's rates may be sufficient, but no more than sufficient to cover its costs. But then say 2 years go by, UI files another base distribution rate case, and now that project is in service, has been in service, and the prudence of our investment was reviewed by PURA in a RAM proceeding. Well, at that time, I think it would be appropriate to transition that project out of the RAM and into base rates. And this, we drew an analogy to the Gas System Enhancement Plan program in Massachusetts. It's kind of like the DIMP that's applicable to CNG and SCG and potentially Yankee Gas, although I'm not sure. It's the cast iron bare steel main replacement program for gas utilities. And there in Massachusetts, utilities spend a significant amount of capital on cast iron bare steel main replacement each year, and the return on and of that investment is reflected through a separate rate mechanism, the GSEP, and they have all kinds of acronyms that start with GSE that describe the different stages of a project, but the company reflects the return on and of GSEP investments through that mechanism. And then when the company goes in for a rate case, any GSEP investments that were in service as of that rate case filing get taken out of the GSEP and into base rates. And you'll see many gas Massachusetts utilities, their filing will include, we're seeking, just to make it up, a base distribution rate increase of $20 million, but embedded within that is $5 million of GSEP investment. So the net effect on customers is a $15 million increase. We think something similar makes sense for RAM projects. These are candidly a much smaller scale than the GSEP, but we think the concept still applies when we have incremental or emergent RAM-related work that we must perform to comport with some PURA order. The RAM is the appropriate cost recovery vehicle for that. But for those projects that are in service, were previously reviewed by PURA, we think it makes sense to transfer those projects into base rates when the company has a rate case. So we didn't mean to say that this was kind of two different approaches, rather one approach with stepped implementation.
That makes sense. Thank you for that response. Just a quick follow-up here. Is there any administrative difficulties in doing the approach that you outlined, shifting cost out of RAM and into base distribution rates? Or any accounting issues that might occur?
There are implications, but I don't think there's a particularly high degree of administrative burden with implementing this. From an accounting perspective, when costs are reflected in the RAM, we already have some special designators in our accounting system to call those out. When we file for a base rate case, in fact, right now there's the administrative, I'm going to call it a challenge, but that kind of oversells how difficult it is. I'll say administrative consideration of you have to carve out those RAM specific projects. So making sure that they're carved in, so to speak, is about as difficult. And then when we go to prepare our RAM exhibits, and when PURA, Lord willing, approves those RAM exhibits, we would need to make sure that we stop reflecting the cost of these projects at the time a base rate change takes effect. So those are some administrative considerations, but I don't think they're particularly burdensome to the point where it would justify something other than what we've recommended here.
Okay, thank you for that response. Those are all my questions. So thank all the witnesses for your time and for answering my questions today. And I turn it back to you, Chairman Wheel.
Thank you. I had one quick follow-up on that, just hypothetically, because this is not even something we can do on the RAM docket, but the renewable connections programs projects, those have been in RAM for a long time. I haven't even looked. There actually might be a statutory basis for that, but assuming that there isn't, I believe there is a statutory basis for them to be recovered through a recoverable mechanism. But assuming there wouldn't, would everything you just said about the hypothetical 7-tier line? I guess my question is the stuff that's already being recovered in RAM as capital projects, as long as there weren't a legal problem with it, would the company also see no ultimate issue in rolling those into rate base instead of having them continue in the RAM recovery?
A great question. I'm just being whispered to, so let me see
Sure.
what that's about.
And while Mr. Hurwitz confers, I'll double check, but I believe we have Mr. Patel here who can speak to the RCP, but I believe the ROE might be a slightly different from UI's ROE. So I just, and that may be from statute or settlement, but I'll pass it to Mr. Hurwitz.
No, great Great question and great clarification from council. Thank you, Attorney Vaughn. Yeah, in concept, we think that the approach that is laid out in CA 72 would make sense for the existing collection of RAM capital projects, but for those things where there may be a statutory reason to do the opposite. I will also say that with respect to RCP specifically, I think the amounts that flow through the MBFMCC are not just return on and return of capital investment. Candidly, I'm not familiar offhand with how much O&M there is or the degree of variability or whether that is also statutorily required to go through the MBFMCC. But I think, but for those kind of project-specific nuances, the overall stepped approach I described a minute ago in response to Mr. Arpin's question, I think would apply to the capital projects currently reflected in the RAM.
Thank you. And can I just relatedly, I noticed that OCC issued 3 interrogatories that were just great interrogatories. OCC 5, 6, and 7. They seem so familiar, but such great questions. And they're covering a lot of the area that we've talked about so far. It's internal O&M, inclusive of personnel, IT, and then just general capital projects. But those interrogatories were answered in January. I was wondering, I'm not sure candidly whether these have been updated in the record, but I know some of them, I think OCC 5 is speaking specifically to actuals, maybe from 25. I was just wondering if it would be possible to update I think that we have had some discussions, I think, for instance, about some of the earlier testimony today actually identifying some of the elements in Exhibit F like weren't included in that because it was just an earlier response. Would it be possible as a late file to just supplement those 3 with the most recent information that we have on those?
I suspect that it would be. I'm just skimming these now. It's not clear to me that all of these require update, but we'd be happy to go through these and update to the extent appropriate.
Yeah, the only thing I caught was I'd been looking at those earlier in the docket and the testimony this morning. I was looking at 5 and there was 1 or 2 things that weren't included in that January response that it sounds like maybe should be in the most recent Exhibit F for this that was filed in March, 2 months after this response, you know.
And I think OCC 7 unquestionably could be updated. OCC 6, maybe not, but we'd be happy to go through this and consider it more fulsomely than I'm doing on the fly here and update as appropriate.
Thanks. So that'll be late file 5 and it'll just be supplement OCC 5 through 7 with the most recent information. Thank you. Mr. White, you had cross?
Thank you. Yeah, I have some questions on the GSC, the BFMCC, and the RDM.
I think we've got the starting collection of SMEs here, so.
Thank you.
Thank you.
With regard to the BFMCC, refer to Exhibit E, page 1. The BFMCC balance on 12/31/24 was $850,000. Why did the company retain this balance for an extra year, ultimately accumulating a balance of $893,000 before returning it to ratepayers?
At the end of 2024, we didn't know exactly if that was going to be the final dollar amount. So we figured to wait until then, although we were still in an undercollected position on the GSC. So we didn't want to flow that back because it's an integral part of the GSC. There's no separate bypassable FMCC accounting. It's just a carve out of the GSC. So at that time, we figured we didn't want to give back when we were undercollected in the GSC itself.
Is this, just speaking of that, is this related to the situation where your BFMCC is normally close to immaterial, pretty small, so you just leave it baked into the GSC?
Well, yes, the GSC, the bypassable is embedded into the standard service rate. So it's an integral component of the standard service rate. So And it really exists only in the tariff and on exhibits D and E. It doesn't exist, the customer doesn't see it on their bill. So they're really integral. And now that the GSC balance is going down, we figured it was time to give it back now.
Okay.
Yeah. But it's important to realize that the curing charges that we had on the overcollection, those are still benefiting the same customers, the standard service customers.
Okay. Thank you. The GSC referred to CAE 68 attachment 1. What is UI's approved annual non-hardship uncollectibles for distribution base rates?
Just to say your question back to you before I go looking for this, you're seeking, in effect, the amount of uncollectible expense approved, reflected in the approved revenue requirement in UI's most recent rate case?
Yes.
All right, just one moment. So I've pulled up Pura's March 3rd, 2026 decision on reconsideration in docket 24-1004, and I've gone to page 91, table
Okay.
37, and I see $3,424,415 of uncollectible expense. That would be non-hardship distribution allocated uncollectible expense.
Okay, and that was 3 million, just
3.424.
Okay. So then I'm wondering about CAE 68 attachment 1. I'm looking at cell C13, which is about 4.4 million.
I see similar.
Okay. So if you're allowed the 3.4 million and then the uncollectibles there is about 4.4 million, what happens with what I'll call the excess $1 million?
That would hurt UI's bottom line if we collected 3.4 million through base distribution rates, but really incurred 4.4. Now that the COVID deferral is a relic of the past, there is no mechanism for UI to collect that remaining $1 million of expense, and accordingly, it will hurt UI's ability to earn its authorized return on equity.
Okay. All right. Thank you. Moving on to the RDM. I'm referring to CAE 66, including attachment 1, specifically row 32, third-party damages.
Okay.
So this account reflects revenues received by UI related to third-party damage on UI's electric system, for example, pole hits. How do you handle the accounting for this? And just so I can sort of explain to you what I'm wondering, if the company has a fully depreciated pole get hit and destroyed by a car, and the next day the company replaces the pole at a cost of $10,000, then is the pole placed into rate base? And if and when insurance proceeds cover the full $10,000 cost, does the pole remain in rate base?
I'm not 100% sure, to be honest, as I sit here now. What I can say is my recollection is that broadly, the expenses associated with third-party damages are reflected as a component of the revenue requirement that we proposed in the rate case, and I suspect Pura approved that particular element of our revenue requirement. But the offset to those expenses is we also receive third-party damage revenue, and that amount of revenue can vary relatively significantly year over year. You see a significant variance in
Yeah.
this attachment here, and I think 2024 was a relatively high amount relative to the years before that. And so we recover the expense through the approved revenue requirement, reflect the revenue through the revenue decoupling mechanism. Your questions about like, how was the amount of the invoice from UI to that third party generated? How does that affect the plant accounting? I'm not sure on those things sitting here right now.
Okay. Okay, second. Yeah. Would it be possible to, Mr. Chair, to get a late file on that, just to get a little bit more clarity on the accounting entries, basically?
Sure, that'll be late file 6. Do you want to give me a prompt?
I had it as clarify accounting entries for third-party damages.
Yeah, I think that's fine. Just to say the elements of your question that I had understood was, one, how does, please describe the process by which UI calculates the amount of third-party damage it is owed? And then second, what are the plant accounting implications of that revenue?
Yeah, no, that's it. If there's any chance to include T accounts in there, that makes it super simple for me. From my understanding, if it's too complicated, do it as you see fit.
Yeah, I myself am not an accountant, but this isn't an area that I've personally explored, so I just don't know what's out there. But I think I understand what you're seeking, and we can put something together for you.
Thank you.
Okay. I have just clarify accounting processes for third-party damages, including plant accounting implications. Does that work?
It seems reasonable to me.
Thank you, Mr. Chair.
Okay.
And another question related to the RDM. My thoughts started with began with CA 66, including the attachment, row 25, third-party poll attachments. But I'm really interested in two other parts of your filings, which are attachment A, pages 13 to 15. It's your narrative related to third-party poll attachments, and exhibit IG.
Mr. White, is that the supplemental, like the March 16th attachment A? Just because there have been a few, or is that a?
I believe IG,
attachment
so
You mean the March 2nd attachment?
I believe I was looking at the March 2nd. Yeah, I'm sorry, I didn't realize it. Okay.
Just keeping you on your toes.
And so I read the narrative and I read the exhibit, and I'm just wondering if you could sort of give me a crosswalk between the narrative and the exhibit. Because it didn't fully jibe for me.
Yeah. So I'll start by explaining the concept of what we're trying to do, and then I will discuss how that's reflected in the exhibit. So everything I'm about to describe only affects November and December 2025, i.e. the years of, or the months of this year's RAM proceeding that are related to Pura's final decision in docket 24-1004. And as we described in testimony, Pura's final decision in 24-1004 included a list of what was countable as other revenues for purposes of the RDM, and poll attachment revenues weren't on it. In the draft decision, there was a similar list and poll attachment revenues were on there, but in the final decision, that line was removed. In the section of the draft decision and the final decision in that case that related to outside service expenses related to third parties who help us with poll attachments, the amounts we had sought for recovery were disallowed, in part because UI is made whole for those costs through pole attachment rates. And in response to the draft, we had said, maybe in concept, pole attachment rates reflect these costs, but we give those revenues back to customers through the RDM. So you can't take them out of the RDM, or you can't take those costs out of the revenue requirement and also require us to give the money back to customers through the RDM. That leaves UI holding the bag unfairly. I don't recall that argument was explicitly addressed in the final decision, but clearly the outside service expenses were removed and pole attachment revenues were not in the list of what counts for as other revenue for RDM purposes. And as we were thinking about preparing the RDM filing for this docket, it occurred to us that if we were to follow the letter of that decision, that would result in UI's rates being more than sufficient to cover its cost, because only a fraction of our pole attachment related costs that are reflected in pole attachment rates are outside service costs. So only a small amount of our pole attachment expenses were removed from the revenue requirement in the final decision in 24-1004, but all of the revenues were removed. And so that felt unfair. That felt like an unfair windfall to us. If we were to just stick with that, UI would retain millions per year in revenue, and a much smaller number, maybe still $1 million, but a much smaller degree of millions in expense would be covered by that revenue, and UI would have rates that are more than sufficient to cover its cost. And that didn't feel right. It didn't feel like it comported with 1619E. So what we proposed in this filing, again, only for the months of November and December where that final decision takes effect, is what we've proposed is reflecting pole attachment revenues in the RDM anyway, even though they were not on the list from 24-1004, but reducing those revenues by any amount of third-party pole attachment expenses that we incurred to earn those revenues. That while the amount of pole attachment revenue we receive should dramatically exceed that amount of cost, that is still a cost. It's legitimate. It's something we incur in the course of doing our business. So to ensure that our rates were sufficient, but no more than sufficient to cover our costs, what we've proposed is what's described in testimony. We've proposed reflecting all pole attachment revenues in the RDM, even though the letter of the decision in 24-1004 does not require us to do so, but reducing those revenues by the applicable amount of third-party pole attachment expenses, i.e. that portion of our cost that's not reflected in the base distribution revenue requirement. If you turn to Exhibit IG, this is our attempt to reflect that proposal. We have a few lines up at the top that illustrate our calculation of pole attachment revenue, and there's a few different lines to get there because the accounting is complicated here. There's one account that has water heater and surge protector revenue in it, so that we have to carve that out. That's a portion of our revenues are recorded to another account, so we have to add that in. But after accounting for those things, you get to numbered line 7, subtotal pole attachment revenue. And for the whole year, that was $6,193,442. But in the months of November and December 2025, we incurred $310,321 of outside service expenses related to pole attachments. So what we propose flowing through the RDM is the net of those two things for the reason that I just described. We're putting all pole attachment revenues offset by pole attachment outside service expenses through the RDM.
Thank you. I think I get it all now. I appreciate that.
Can I just jump in really quick with a clarifying question? That, as far as I can tell, I always have to catch up with the March decision in your last rate case because I was so sad to be on what I call recusal vacation for that portion of the docket. It doesn't look like that. I'm seeing there was no change to the authorized pole attachment revenue from the November decision to the March one, and it looks like it doesn't look like the final decision changed at all moving forward from what you just described. Do I have that right?
It didn't appear to us that there are any changes related to this topic
Yep.
in the reconsideration decision.
Okay, thank you.
Yeah, and there was my colleague is offering me a good clarification. There was the change that I described between the draft decision and the final decision, but not between the final decision and the reconsideration decision.
Thank you. Yep, I did understand that. I was just trying to, I was hanging up on, I do understand that your specificity that it's only November and December, which I understand is because that's what we're measuring here, but I just didn't know if it was going to change again as a result of the March decision, but I see.
No, I don't think so. And just to keep you really on your toes, my understanding is the March decision set rates back to November 1. So.
Yeah. Okay, thank you.
Thank you again. And just to be clear on this, so for 24-10-04, the poll attachment revenues were removed
From
November 1st.
November 1st, and they were removed from the list of revenues to be included in the RDM. There was still words about, how those rates were to be calculated and whatnot. But then if you give me a minute, I can pull up the precise table because I've only been alluding to it. It's table 87 on page 213 of the March reconsideration decision. There's a list of other revenue included in the RDM calculation, and poll attachment is not on it. But if you were to pull up the comparable table from the draft decision, there would be a line for poll attachments.
Thank you. And just so in relation to 220808, it was listed.
I candidly don't recall that there was a similar table in the 220808
Okay.
decision. There may have been, and I just don't remember. But
Okay.
in the years where we calculated the RDM based on the rates established in that decision, we did include poll attachment revenues. And
Okay.
there were no similar poll attachment expense exclusions like we saw in the 24-10-04 decision.
Thank you. Appreciate it. And with that, I'm done.
Thank you. And that satisfies it, authority staff? Crow?
Yeah, that's it
Okay.
for me now. Thank
Why
you.
don't we break for lunch until 1 and then we'll return for OCC? Does that sound good? Thank you.
Yep.
Okay, we are back from lunch in docket 260104. I'll pause for any administrative matters that may have come up over the break.
No, none from the company.
Okay. So with that, if everyone's ready, we can resume with Cross from the Office of Consumer Counsel.
Hi, I'm Rory Apollonia. I'm an accounts examiner for OCC. Good to see everybody. Good afternoon. So my first question's gonna refer to 2025-05-26 Attachment 1, Exhibit 1G, TAC Supplement 1 Microsoft Excel spreadsheet, tab 2025 Revenue Requirement. FF1 versus TAC, column I, labeled L and S allocator factor, percentage gross plant. Let me know if you can find that.
So I suspect I can, but just to make sure I'm pulling up the right information, you're looking for a file from last year's RAM proceeding, docket 250104, and it sounded like the attachment that accompanied our supplemental testimony relating to the FERC Form 1 true up in that proceeding.
Correct, yeah, it came from your pre-filed testimony.
And you referenced the LNS factor percentage of gross plant. Is that a percentage of 2.3147 that you're seeing?
I'm pulling it up. Yes, so you said it's 2.0381?
That may be the percentage this year. I haven't pulled that one up, but I'm trying to pull up what I think you were referencing. The document I have in the column you pointed to reflected a percentage of 2.3147.
Yes.
Okay, then I've got the correct document up.
Okay, thank you. So my question is, how did the company determine the factor to be that?
Yeah, great question. This factor results from our PTF study or Pool Transmission Facility study. Each year, as part of the settled formula rate template we complete for purposes of our transmission rate making, we study the percentage of our transmission plant that relates to the region, RNS, local customers, LNS, and Schedule 12C, and the proportion of gross plant that relates to each one of those things determines the portion of our allocable transmission revenue requirement that is reflected in the regional rate, is reflected in the local rate, and is reflected in the Schedule 12C rate. This particular percentage, the 2.3147, would reflect the LNS allocation factor resulting from the PTF study based on a calendar year 2024 test year used to set rates that were relevant to last year's RAM proceeding.
Okay, thank you. So for my next question, just to be clear, I'm looking at the 2026 spreadsheet, which came through your pre-filed testimony. So this is attachment 1, exhibit G, TAC supplement. And for this question, I'm going to look at column N, which is labeled rate year 2025 TAC. And it's the same tab. The tab here is 2025 revenue requirement. So for this question, I'm just wondering, again, can the company provide me where it's getting the rate year 2025 TAC number?
Are you asking about the LNS allocation factor, or I heard you point to column N, like as in Nancy, the column labeled rate year 2025 TAC, or are you asking about that column instead?
I'm looking at column N, which is Nancy. So if you look at N, if it's cell N7, I'm seeing a number here of $1.3 billion for the TAC. Do you see that?
I do.
All right, yeah, could you just walk me through, because it's not linked to formulas in your spreadsheet, it's hard coded in there, so just walk me through how you're getting that number.
So second, let me just double check a detail with my subject matter expert. One moment.
Okay.
Excel column N is in concept, the thing being trued up in this supplemental testimony to which this document was an attachment. Excel column N was our guess for what our 2025 revenue requirement would be for TAC purposes before the FERC form was filed. And we do our best to make that guess as accurate and reasonable as possible. We don't just make it up, but we reflect, the best, most current information available at the time our filing is due, sometime in February. But that's before our FERC form is due to be filed, and the FERC form includes certain key inputs that are impactful on the TAC rate. And so in this case, just mathematically, you can see Excel column O, one to the right of column N, shows the FERC form 1 versus TAC 2025. And you can see the different piece parts that show how the guess contained in column N compared against the actual results shown in Excel column M. And since Excel column M is what we're asking for now, there are more formulas reflected in that column for you to trace through.
Okay, so you're saying column O is like a variance column between column M and column N.
Exactly.
Okay, thank you. Thank you for clearing that one up. So my next question, I'm gonna refer to the same spreadsheet and tab. I'm gonna look at cell K20. It appears to be the cost of capital rate of 10.4832%. And again, this number is hard coded into the spreadsheet. So I would like to know just how the company is coming up with that percentage.
We could provide a late file that illustrates this exact calculation, but in concept, this will be the approved cost of capital for transmission rate making purposes as it relates to 2025. The FERC formula rate is just that. It's a formula. It's not a stated rate like we see in distribution rate cases. So the capital structure and cost of debt change annually. The ROE is set by FERC on a periodic basis, and as we talked about this morning, is currently the subject of some litigation, but this would reflect the cost of capital included in the FERC formula rate in 2025. And I don't have the details on my fingertips, but would be happy to provide a late file providing that information.
Yes, OCC would like that if possible.
Sure, that'll be late file 7. And it'll be reference 2026-05-26, attachment 1, exhibit G, tax supplemental 1. Please provide the derivation of the 10.4832. Got new glasses prescription coming this week. I'm really excited. I think I had that number right. Capital cost rate in that tab.
I think you nailed it.
Okay, thank you. Moving forward, so I'm gonna look at the same spreadsheet, but I'm moving the tab Appendix A, ATT UI-1, column H. And for here, just let me know when you're there.
I'm there.
Okay. How did the company determine the $10,321,136 for general plant, 100% allocated to distribution?
I'm just gonna take 1 minute to see if we can avoid another late file. Just
Yeah,
bear
no
with
problem.
us, please.
Mr. Apollonia, while we're waiting, could you repeat the question? Because I was still writing out that I need to catch up to where you are.
Oh, sorry. All right, so question is, same spreadsheet, looking at Exhibit A, ATT UI-1, how did the company determine 10,321,136 for general plan, 100% allocated to distribution?
Okay, gotcha. Thank you.
I think I unfortunately will need to take another late file on this one. It's a footnote to the FERC Form 1, but I just went to go review that footnote in the attachment 2 to the supplemental testimony, and the page has some print issues, so the footnote's not clearly legible. But my recollection is it is a footnote to the FERC Form 1, and via late file, we can clean up the printing of attachment 2 for you.
Would it make sense, Chairman Wheel, to append that to LFE7 unless you've already entered it into your system?
It would make sense. I got as far as copying and pasting LFE7 to make that edit to it, so it makes sense to just add the edit to LFE7, so I will do that. So it'll be the same reference, just to the different tab. And was the question just broadly how the derivation for the allocation of plant to,
Yeah, yes.
okay.
I can say some words about what this represents if that would be helpful, but yeah, the strict answer is this is from a footnote to the FERC Form 1. The slightly longer answer is these particular assets represent assets stemming from the push down of UIL assets to UI maybe 8 years ago now that were split between transmission and distribution at that time. And this is the amount on UI's books as of the end of 2025, footnoted in the FERC Form 1.
Okay.
Okay, so I added that to late file 7.
All right, so I have another question which is related, so we may have to put it into the late file, but let me ask my question. So one row down, cell H20, how did the company determine the $4,229,132 for general plant, 100% allocated to transmission again?
I believe it'll be the same answer, but just the transmission equivalent of what I just said.
Okay.
And I think that'll actually already be capturing what I wrote here was I referenced the tab and said, please also explain the derivation for the allocation of plant as reflected in this tab. So that should cover all plant, how it's allocated.
Seems reasonable to me.
All right, thank you. So I know you were referring before to the FERC form. That was one of my later questions. We noticed that the FERC form has parts that are like written over itself, so it's not good. So you're gonna resubmit the entire FERC form, correct?
Yeah, that's probably what we'll end up doing. I just pulled up it's PDF page 62 and it's difficult to read. I suspect you're correct that this has infected other pages as well.
Yes. Okay, thank you. Okay, so I'm gonna move forward. I'm gonna refer to May 13th, 2026 UI compliance with Order 2 from the interim decision. Hashtag 260104, Order 4 decision, 241205 filing. Excel spreadsheet 2026-0513 UI attachment 2.
I think I am there and we have our SME has come up to the table,
Okay.
assuming I heard the reference right, but I think I did.
Yeah, what I'm looking at, just to make sure I'm in the right place, is the May 13th filing, the spreadsheet.
Yes.
Okay.
Yes.
2 tabs, one called summary, one called sheet 2.
Yep.
So I'm opening up the file right now. If you bringing up other people or
I think we're good. I think
Okay.
we got there.
got it? All right. So my question here. So I'm looking at the column amounting rates. And how did the company calculate the negative $18,828,133?
That should be the amount reflected in the interim decision in this proceeding. If you give me just one moment, I can confirm that and give you a page reference.
Okay, thank you.
Yeah, the value of $18,828,133 reflected on the sheet 2 tab of the spreadsheet, which you've referenced, can be found in Pura's final interim decision in this proceeding on page 9. It's the first row of table 3.
Okay, thank you. So this may be similar, but I'm gonna ask it. If you look at column total year over year, over under, so there's a negative $17,337,550. Is that a similar calculation you have there?
So that is, I'll take the first crack and then let Mr. Stanley add as he sees fit. It's similar in concept to the line that I just pointed to, but the source is different. This represents our calculation of the most current equivalent of that 18.8 million based on information that was not available to Pura at the time of the final interim decision. You can see that same figure on the summary tab of this same file in Excel cell N9, which relates to the variance between 2026 anticipated net costs and 2025 actual costs. This is attachment 2. There's a confidential attachment 1 that I won't open now, but it provides a more detailed illustration of how this number was calculated.
Okay, thank you. So moving forward, so I have another question on the same spreadsheet, and if you look at the top left, it has sales per kilowatt. Is the company having any issues in determining sales per kilowatt, which is listed?
You say sales per kilowatt, you mean the kilowatt hour sales of 4,875,000,000 and change in cell B2?
Yes.
All answer and let my peers add to the extent they see fit, but no is my answer to that question. This represents the actual sales of the company in the last calendar year, and that's something we're able to determine without too much trouble.
Okay.
There, in years past, was some debate about the appropriate amount of kilowatt hour sales to assume when designing rates for RAM purposes. And I don't recall which RAM docket, but one RAM docket a few years ago, there was some direction from PURA to use prior year actual sales as the surrogate for the forecast for upcoming year sales.
Okay, thank you.
I'm being told that was from docket 220908, which makes sense logically.
Okay. So I'm going to refer to April 24, 2026, Order 1 from the interim decision. This is docket, the current docket. It's Excel spreadsheet. Attachment 1, RAM, rate calculations, tab, Exhibit K1, page 2 of 3, TAC revenue requirement, row labeled 6, quote, less 2023 K and M, EDIT, ending April 30th, 2025.
I am there.
Okay, thank you. I'm not familiar with this calculation. Can you explain why the 2023 K and M EDIT is ending in 2025 and thus has a $774,736 impact here?
Candidly, I forgot the specifics of the fact pattern that gave rise to this issue. I do recall that it relates to excess deferred income tax amortization, but I think and there was a data request in, I believe, last year's RAM where we talked about the specifics further than I can recall sitting here now. But the key concept here is this was a long-term amortization, I want to say 22-month amortization established multiple years ago that concluded in 2025, as shown here, it concluded on April 30th, 2025. The way the TAC calculation works is similar to how all of the RAM calculation works, with the exception of the RDM. We study what actually happened in the so-called historical test year, 2025 in this case, and then use that as the jumping off point for projecting the future. But this is an amortization that's ended and will not recur. So the adjustment that's shown here is to exclude that amount from the basis of our calculation going forward, so we don't inadvertently double count or overstate our needs going forward in the future. And as I look at this, I think in this case, it's actually the same concept, but the inverse. This is an amount of revenue embedded that we're excluding, so it's comparable to our expenses. But this is something that's done, so we're taking it out for calculation purposes.
All right, thank you for explaining that. That's very helpful. So just referring to the same spreadsheet and tab, if you look at column C, which is labeled as the source, I think the source information is very helpful in understanding to me. So my question is for rows 3, 4, 5, 6, 8, 10, and 17, the company hard codes the numbers instead of linking the cell to TAC Exhibit G, page 1.
One moment. That's a fair question. I'll note that this whole document, there are tabs in here that look a lot like our RAM filing. It is not our RAM filing. It's a Excel spreadsheet providing our rate calculations, and this particular tab, like some other tabs in here, replicates that sort of first sheet of our rate calculations, but this is technically not Exhibit G. It's something that looks a lot like Exhibit G. So we're referencing, as you can see in the footnote at the bottom of this exhibit, we're referencing to the Exhibit G that was filed. And if you pull up Exhibit G, page 1, you'll see a spreadsheet that looks very, very similar to this, but it has a different set of footnotes explaining each of the rows. That makes sense in the context of that exhibit. But since this is a spreadsheet used for rate calculations that's replicating Exhibit G, you can see many of the rows are simple references to Exhibit G, and we can't link in the Excel formulas because that file is not contained within this file.
Okay. Thank you. So that's helpful. Just my next question is, we're going to refer to the same spreadsheet and tab. Just if you're looking at column C, rows 24 through 27, I see the company states internal company records. We were just talking about that. And the numbers are hard coded in. Do you have evidence that these numbers are accurate?
Thank you for the question. My recollection is you asked something to the effect of, do you have any support for these numbers? And the
Yes.
answer is, we do. These come from our general ledger, and we'd be happy to provide a late file with some further accounting details supporting these numbers. It will be less clean than this presentation. It'll be an extract from our accounting system, but we would be happy to provide you further details for supporting these numbers.
Yes. And my next question would add to it as well.
All right, that'll be late file 8. That's gonna have it as, please provide supporting detail for the internal records reference.
Yes.
You said you had a follow-up building on this request.
Yes, yes. So I guess we can go into the follow-up. So the follow-up is a similar question, but I'm just referring now to tab Exhibit K1, page 3 of 3, the SBC revenue requirement. And you go to column D, and it's rows 24 through 27. Again, company states these are internal company records. The numbers are coded. I'm just looking for further evidence that these numbers are accurate.
It'll be the same answer. I'm happy to add that to the late file as Pura sees fit.
Okay, thank you.
Can you just repeat the tab, Mr. Apollonia?
Okay, the second tab is Exhibit K1, page 3 of 3, SBC.
Got it.
Requirement, column D.
Okay. And the first request, was that for the TAC internal record, the TAC tab?
K1, page 2.
Yep. Okay.
Yes, thank you.
All right. I added that to the late file.
All right, thank you. That's all the questions I have.
Good afternoon. Kim White with the OCC. I suspect most of my questions go to Mr. Daniels, but we'll see. So let's see. My first question. So in last year's docket, there was a discussion about MPP costs and that the cost reflected customers that were on MPP without an arrearage. I just want to clarify that was solved and these costs don't reflect that. You want me to say it to you again? Okay. Okay. So last year, you'll recall, we found that there were customers who were on MPP who did not have an arrearage. Have you reprogrammed your system and you guarantee the costs this year don't reflect those types of customers?
Yeah, customers without a qualifying arrearage would not be enrolled in MPP.
Okay. So then now I'm going to turn to Exhibit H, supplemental. You let me know when you get there. These are SBC calculations.
Will take me a moment.
And I'm going to be in tabs 2 and 3, pages 2 and 3 in the Excel.
You said H supplemental, correct?
Yes. It's an Excel file. 316.
We're there.
Should be all set.
Okay. Okay, so I'm looking on page 2 refers to a lighter revenue requirement 2-tier implementation.
Yes.
Okay. Are all of the costs on pages 2 and 3 toward the 2-tier implementation, the 2-tier lighter?
You asked if all the costs on page 2 and 3.
Well, they're the same cost. It's
Could you just maybe rephrase your question or hit us with it again?
okay. So on page 2 of the filing, the lines are not numbered the same. It's line 12 and you're numbering, line 14 in the Excel's numbering. It says lighter revenue requirement, and in parentheses, it says 2-tier implementation. And there are costs there, and those are the same costs that go across the 12 months of page 3. Those costs are for the 2-tier implementation.
That is correct.
Not the 5-tier
Not
implementation.
combined with 5-tier, correct.
Okay. So I think what I'm trying to understand is that the decision for 5 tiers came out in November 20th, 2024. So why did you keep building the two-tier lighter throughout 2025?
Those aren't costs that are continuing to be incurred for work being done on tier two. Those are the rev rec for that project once it went into service.
And that's exactly right. And just to build off my colleague's answer, you pointed us to a specific document included in our March 16th supplemental filing. We included another document. It was called Attachment 2, showing the revenue requirement on all capital projects included within the RAM on the summary page of that attachment. This is line number 6, and it's exactly what my colleague described. This is the revenue requirement on the investment. It's unlike an operating expense that you incur once and recover once. The capital investment made by the company in relation to this was larger than 190,000, but 190,000 reflects the revenue requirement on that investment, the return on and of that capital investment.
Okay. Same exhibit, line 20 on same page 2. It's your line 20 and line 22 in the Excel file. Third-party collections. What were the specific legal collections activities associated with these costs?
So these were accounts that were placed with our legal collections firm. Yeah, so those are the costs incurred for accounts that were previously placed with legal collections.
So when you say previously, when were they placed?
So prior to the company pausing legal collections in 2022.
These were costs.
So I mean, you're talking about accounts with, potentially significant balances that they're on a sort of a payment arrangement over a period of time. So they're continuing to pay that down. Those are the commission costs associated with the collection of those monies.
Okay, so all of these are commission costs that we're looking at here then.
Yes.
Paid to the legal collections firm.
Correct.
Okay.
And
oh, sorry.
just right. So if you look the comparison between this year and the prior year, you can see the amount has dropped pretty significantly as over time those balances are reduced, and therefore the commission that's being paid on those is less. We would expect with for next year's filing, we might see that increase as we resume, legal collection efforts.
Okay.
And just to build off that answer, you can see that same trend continuing in our filings from the previous year's RAMs. This has decreased each of the 2 years before what's shown here as well, more than cut in half each year.
And line same exhibit, same page, line 21 in the other. So when I looked this up in the glossary, it says it's maintenance and ongoing programming cost for the operational and maintenance of UI's customer-facing data dashboard. Just want to clarify that's.
So that's what it was in 2025. This year, those costs for other are actually postage fees that we paid to a third-party vendor.
Okay.
The work on the data dashboard did not move forward. So that is not the data dashboard. Those are associated with postal fees for correspondence sent to customers.
Okay. What sort of correspondence?
The couple of the examples of letters where there's medical letters sent to customers, LIDR usage cap letters, and hardship transition letters.
Okay, I'm actually turning to a different exhibit now. On May 26th, you filed Exhibit A testimony supplement. But what I'm specifically asking is it referred to the docket number 241024, motion number 124. There was a spreadsheet showing the metrics. I just want to ask you a couple of questions about that spreadsheet.
Swap computers again.
You're referencing the spreadsheet from the rate case docket?
Yeah, that you referred to in your testimony on May 26th.
I got you. This might just take us a minute to pull up, but bear with us.
Attorney White, if you could be so kind to repeat where that's coming from exactly, so I can locate it.
So I'm going to take you down the chain here, okay? In Exhibit A testimony supplement that was filed on May 26th, you refer to the metrics that were filed in docket number 241004. And if I wrote this down correctly, it's motion number 124. It was the order number 6 compliance filing, attachment number 1. Well, it was a motion associated with the order number 6 compliance file.
All right, I dug it up. My colleague may need a moment, but you said it was the Excel attachment to that motion?
The Excel attachment,
All right.
yes,
Yep.
please.
Thank you for the patience.
Yeah. No.
I have it now.
Okay. So I'm on the tab for metric 3. Does the monthly number of customers in a payment arrangement, does that reflect customers actively participating in a payment arrangement or enrolled in a payment arrangement?
Can you differentiate between actively participating and enrolled?
Actively participating means you're making a payment. Enrolled means you're enrolled and you could drop off the next month. Or 2 months if it's
Well,
MPP.
Right, but sometimes the payment requirement wouldn't actually be in that month. Those are the number of customers who are, and they'd be enrolled at any given time during that month.
Okay. Sure.
Yeah, and just for clarification, for the baseline calculation, the enrollment number was used to calculate the baseline.
Understand. So I would actually like to ask for a couple of LFEs to help me better understand some of the material in this spreadsheet. So if I could, please, Chairman, and I'll make it 2 LFEs because they're going to be a little bit complicated and it's probably going to be easier if we break this down into 2.
Okay. Starting with,
I'll hold off on responding, I guess, until we hear the LFEs, but just wanted to gauge that I may be responding.
okay. So we'll start with late filed 9. And I'm ready to hear it.
Okay, so this is for the tab that says metric 3. And just for the customers in the 2025 column. Those are the customers it's saying that left a payment arrangement during that year. if we could just break those down, and this is where I'm going to get a little complicated, okay? For residential versus commercial. And then within residential, if it's hardship or non-hardship. Type of payment arrangement, which would be, it's one of two, FPA or MPP. Arrearage amount. And what I'm going to call current disposition, but that basically means, are they still on the payment arrangement? Are they terminated? What happened to them?
I'm going to object to the late file in that I understand that the attachment was referenced in the supplemental testimony as it related to the inclusion of executive compensation in this case. But we're getting into the weeds a bit about a motion that was filed in another docket and was already ruled on in that other docket with the explanation provided in that other docket. And I just don't believe this is the appropriate venue to litigate that motion. I think that motion was filed at the end of January and was ruled on, I think, on March 9th or March 10th, following the Phase 1 RAM hearing when this was discussed. So I just don't know the extent to which we're sort of reopening a closed issue there.
If I may respond.
Sure.
On May 26th, they made a filing asking for approximately $400 and some odd thousand based on this data right here. I just want to understand the data that we're attempting to award them executive compensation on.
Yeah, I'm going to overrule the objection. I understand the objection, but I think this is the first time that the prudence of this that this cost has been evaluated. The motion ruling wasn't a evaluation as to prudence. So here, I mean, here where the cost recovery is happening, potentially OCC could make a prudence argument using this data.
Before I comment, I'd just like to try to say your request back to you to make
Certainly.
sure that I've got it.
Mhm.
So with respect to metric 3 in the spreadsheet to which you pointed us, and specifically the customers in the 2025 column, you're seeking first a breakdown between residential and commercial. Next, with respect to the residential portion of that breakdown, a further breakdown between hardship and non-hardship. And then for all customers, you're seeking the arrearage amount and current disposition of their accounts.
Right. So honestly, the way I would picture would be the easiest way to provide the information would be, and certainly we don't want, no customer identifying information needs to be, you can anonymize all of this. I would probably just go customer by customer and say customer A, residential, hardship, non-hardship, arrearage, disposition. That probably makes the most sense,
So I
if
think
that makes sense to y'all.
I'll make a comment and let my colleagues jump in to the extent they see fit, recognizing Chairperson Wheel's ruling on the objection. I think we can take our best shot at this, but this is a difficult late file to answer, so we might not be able to provide all of the information you're requesting in the manner in which you're requesting it.
To that, I'd respond without being requested to that I'd throw in my normal caveat that, I mean, I think the company can provide as much information as it can on the timeline, can explain what it could or couldn't do, and we'll take what we can get in time for the late file hearing.
I got you. Yeah, I won't be me who has to go through the pain of putting this together. I suspect some of this is doable and some of this is not, and we can explain it to the greatest extent possible in our late file response.
And just to understanding the overruling of the objection, I think in my objection, I think I maybe didn't draw an artful distinction here, but I think I was seeing one between the calculation of the baseline, which was motion 124, and the actual compliance filing of the results, which is what the prudence is based on. So I think that's what I was bucking up against, is breaking out the baseline versus maybe breaking out the results. I'm not sure which is more germane to this case and the dollars at issue.
And I guess to just to add to that, we endeavored to use the same methodology in calculating the baseline as we did for this most recent submission as any changes to the way that we would calculate our results from 2025 would then not make it an apples to apples approach to what we submitted for our baseline. And I think that kind of goes against the idea of creating a baseline, what we're benchmarking against.
If you're saying you want to do it from 21 through 25, you are more than welcome to provide me that information. I was attempting to limit it if you.
I think we're saying the exact inverse of that, that the baseline that Pura has already approved reflects one methodology, but we understand the objection ruling. We understand the, scope of what can be done when the time allotted, and we can do our best to put together as much of the information as you've requested as possible in the time allotted.
Yeah, I understand Attorney Vaughn, and I understand the objection again, but I mean, what it comes down to is that this is the first opportunity that OCC as a party has to probe as to the recovery of these costs, and what else could they look at in terms of probing here other than this data? I mean, so I think I'm still going to overrule, but we'll also understand the company can only get what it can get, and we'll sort of see what comes of this. It is worth maybe considering in the future, though, that if this is an ongoing cost that the company is going to continue to incur moving forward, we can try to catch this earlier.
I guess setting all of that aside, did I restate the question accurately, at least what you were seeking?
Yes.
Okay, all right. Then I think we understand and we'll do our best.
I'll read out the late file I have, which is reference docket number 25-1004, motion number 124, attachment tab 3, customers in 2025 column, please break down by residential versus commercial, hardship versus non-hardship, type of payment arrangement, arrearage amount, current disposition, i.e. still on payment arrangement.
That sounds right.
And Chairman Wheel, I think I heard you say 25-1004.
24-1004, yep. And thank you, because I did write down 25, so that's helpful.
I'm sorry to do this, but as I said, it was 2 late files and I have a second one. I think this one's easier actually, though.
The second one will be late file 10.
Yes. And this one's from metric 4. And for the 895 customers shown in the 2025 tab, recognizing everything you just said about the baseline that you were talking about, and with my caveat still in there, if you want to give me more than 2025, I'm happy to accept it. But can you show how many payments each customer made on their customer payment arrangement? Give me the number of payments each customer made on their current payment arrangement and their current arrearage balance.
I'll raise the same objection just to preserve the record, but understand that
We will
And Attorney White, do you want to respond to the objection?
same as before, as you said. This is our first opportunity to look at the prudency of this, and we're just attempting to understand the metrics as they've been presented to us.
Okay. Sure.
If I could restate the question with reference to that 895 customer number. So for each customer, the number and amounts of payments they made in 2025?
The number, I actually said the number of payments they made. You don't have to give me the amount of payments they made. It was the number of payments they made and their current arrearage balance. So it would be customer A made 5 payments and owes $1,000, if that makes sense.
Yes, it does.
So in your perfect world, you'd get back a spreadsheet with 893 rows and 2 columns.
895, but yes.
895. I understand.
Well, 3 columns, customer A, yeah.
Just for the record, I didn't rule on the objection. I'm going to overrule again for the same reasons as before. Thank you. And I'll also add the same. The company will do its best to provide a spreadsheet with 895 rows, and we'll see what we get to. And lastly, just to say it back to you, late file 10, reference docket 24-1004, motion number 124, attachment tab 4, 2025 data. Please break down the 895 number by the number of payments each customer made and their current arrearage balance.
Yes, please.
Okay.
gonna continue? Okay.
Yes.
Okay. You'll be grateful to know I'm almost done. So, I do have I might have another late file exhibit, but this one's way easier. There was a discussion earlier regarding billing systems, and I was desperately trying to look through the record to see if you have the current contract with your billing system vendor in the record. Do you know if you do?
Subject to check, I believe we did that in one of the latest batches of interrogatories. but
Okay.
I will double check.
Okay.
Just to follow up on that, CA 42 contains, attachment 1 contains that master service agreement with the current vendor.
Okay. Thank you very much. I will turn it over.
Good afternoon, commissioners, and to the panel. Claire Coleman, Consumer Counsel. I just have questions, just a couple questions on the DER solar programs and then on the GSC. With respect to the DER programs, thank you to the UI folks who have been responding to our numerous interrogatories on these. You probably inferred we're just trying to figure out, we're capturing all the costs in one place. So I just want to kind of walk through that and make sure that is in fact the case. It seemed like from our numerous follow-up interrogatories that you have in fact confirmed that OCC 1 captures all of the costs, for example, RRES, NRES, both rec costs, net metering costs, or net energy billing costs, I should say. Is that correct? So when it says, for example, if you go to OCC 1, attachment 1, LREC, ZREC, RCEP, SHREC, RRES, NRES, SCAF, those are all listed, and then it says total cost and rates, and you provide a number. We were, trying to determine if UI had anything similar to what in the Eversource world is the NCQF, tariff, or other tariffs. So I just want to make sure that we're now understanding that UI does capture everything within that one cost captured. One second.
I was asking about the NCQF because I actually don't know how to define it. Could you, do you have the definition of NCQF?
So the NCQF is where Eversource captures net billing costs. But I don't think you have to worry about that. If you don't know about it, it's complicated. So
Yes.
I think I could ask more
I
direct.
do know that they do it differently than we do.
Right.
So I think that that's we would agree with your premise that we tried to answer it to provide you the clarity of how we do it. And we do know it may be different than the way Eversource has chosen to present it.
And when you, sorry, just pulling up with OCC 1, attachment 1, the program / category, for example, RRES, NRES has total costs and rates. That includes any cost of credits customers receive through net energy billing constructs.
Ms. Miller can further response here, but yes, the way we present it is, and if you look through our glossaries and you'll see the line items, we try to present to you both the netting and buy-all costs separately, and we recover for specifically NRES and RRES. That includes the bill credits.
Right.
Yes.
Great. And then the one follow-up I wanted to confirm whether the interaction between the grandfathered rider, the NEC one, which was associated with the RSIP and SHREC programs, is that also the case that costs associated with that tariff would be reflected in the total cost and rates for those legacy programs in OCC one?
One moment, please.
Sure.
Okay, let me make sure I get the question. The NEC one rider is to pay for the excess energy that is provided to customers, excuse me, that customers provide to the grid. As I understand it, that has been applicable to the excess energy for the LREC ZREC program, because in the RAM is only the LREC ZREC cost associated with the renewable energy credit purchase. That's similar to, you also just told me two other programs. What were the other two that you mentioned?
The SHREC, RSIP and SHREC.
Yes, yeah, the RSIP and SHREC. RSIP is a program administered by the Connecticut Green Bank, but the corresponding purchase that's associated for the electric distribution companies is known as SHREC, Solar Home Renewable Energy Credit.
Right.
It's the purchase of the renewable energy credit outside of the RSIP incentive that the Green Bank gives to customers. And yes, what's in the RAM, similar to the LREC ZREC program, in the SHREC, the request for that line item is just for the renewable energy credits, and any excess energy is under NEC one. It is not recovered in RAM.
Okay, so if we were attempting to quantify holistically the costs of these programs, we'd want to add the costs of the rider NEC one to what you're identifying in the RAM?
Yes, precisely. In fact, that's one of the improvements that we mentioned when the NRES and the RRES programs were created, that we thought it was a more holistic way to look at the incentive. Whereas historically, if you just looked at the LREC ZREC, you could point to the incentive payment that was paid for those projects, but it was not including the overall energy value that the customers were compensated for.
Thank you. That's very helpful. So okay. OCC 42, which UI has not been within there's still time for you to respond to, was a follow-up to try to capture a historical look back on costs. I'm reluctant to ask this, especially after all my colleagues gave you guys so much additional homework, but I was hoping to be able to supplement that ask both with that understanding. I think we asked for various cost information related to not just solar, but all of the different costs. Actually, you know what? I have to strike that because I think OCC 42, it captured EPAs as well. So let me just, I think it's cleaner if I just ask for a standalone late file exhibit. And this is really to gather parallel information that we've requested from Eversource, which is, can you provide the total costs historically from 2018 to 2025 for the programs that are in OCC 1, LREC, ZREC, RSIP, SHREC, RRES, NRES, SCEF, and I guess energy storage solutions, though that won't go back that far. And then I just ask that also include the rider cost information, and then that might help us have it all in one place. the rider neck one tariff costs for each year.
We may have some further comments in a second, but you were reading off those programs kind of quickly. Was your intention to say all of the things in OCC one or just a subset?
Well, there's a lot, there's also affordability programs in OCC one. I'm sure if you'd like to provide that as well. We are looking at, doing historical look back on costs, so,
It's like I heard a
wouldn't
lot.
object, but knowing that you've got a lot to do in a short amount of time, I think focusing on the, the PURA approved DER programs is what I was seeking to clarify. So would be rows 12 through 17 on OCC 1 attachment 1.
Okay. So I guess I would just, in response to the question, before we finalize that question, I'll just point out that, some of these programs were not in existence in 2018.
So it'd be 0.
Okay.
Yep.
Just being very clear that we do not have data for all the programs that you're asking for, since they didn't begin, or even if they began, we wouldn't have had any project in service. So therefore there might be zeros there, and we'll try to explain that. 18 to 2025. And I believe we answered a question, or we started to answer a question. Sorry, Ms. Miller may have something to say. One moment, please. Thank you for bearing with me. When we did receive those questions and we started looking at them and talking about how we were going to answer them, and so I was just asking a colleague about, I know that it can be a challenge presenting the net energy amounts. One is that our systems aren't quite linked because the LREC ZREC programs are paid off bill, and so and they're different meter numbers. It's a confusing, trust me, it's confusing, and it can be a challenge for us to get that information. But even if we can get the information, which I hope we can, we're only paying for excess, this is excess energy, but with net energy billing and the historic, it's put into a bank and then paid out at the end of the year. And so it won't provide a perfect kind of match between kind of production for those systems or excess energy and the ultimate payments. So I just want to make everyone aware and put on the record that those numbers may see you'll see a payment or something in April, but nothing throughout the rest of the year perhaps. And so that's on purpose because they're banked. And then if the customer doesn't use it, they get a payout. And so we can explain that, but I just wanted to explain why the numbers won't match. And I don't think there'll be any way for us to do that.
Okay, we'll review it with that lens and, recognizing different billings and accounting systems that should still give us a sense.
Yeah, it's just a function of the way the grandfather net metering worked and the fact that it's a bank and ultimately a payout, which is different than what we do today, which is a payment. It's not stored kilowatt hours and then an ultimate payment out. Hopefully that made sense.
It did. Yep.
That'll be late file 11.
Oh, thank you, Chair.
I have it as provide total costs historically from 2018 to 2025 for the renewable energy programs referenced in OCC 1 Excel rows 12 through 17, along with NEC 1 tariff costs for each year.
Thank you. And not to complicate things, but I just realized I should clarify to OCC 1 attachment 1 total cost and rates for those programs. Does that include administrative costs that have been discussed in other contexts for each program? Like, would that build in the admin costs that are also passed through the RAM? Or would we have to add those as well?
I have a general two-part answer to that. When the NRES and RES programs were created, there was recognition or request in those dockets to create a fee to process applications to essentially cover or attempt to cover some of the administrative costs
Right.
and charges. And so I think the answer is for NRES and RES, we do have the admin numbers.
Okay.
Clearly, we can provide that. That was provided as a credit. And as you'll see, the prior years of the RAM, you'll see a credit and those line items to reflect the application fees, which were meant to recover administrative charges. The other administrative costs, I think, to administer LREC, ZREC, and some of the other programs that have been recovered in the under the non-bypassable has historically, as I mentioned at the beginning with Mr. Bowman's questions, was traditionally under the wholesale power contract labor line item, which historically has not been broken out with specific detail until this year.
Okay. So then understanding there's different treatment between RES and NRES and the legacy programs. For RES and NRES, those application fees that are intended to cover admin costs, is that reflected in the column C, total costs in rates of OCC 1 attachment 1, or do we need to add those two together to get a total cost?
Thank you for your patience. As presented in the RAM, the non-bypassable FMCC exhibit F, page 2 matches the total numbers that are provided in OCC 1 attachment 1.
Okay. And that will tell me, if I go back to that, will tell me what specifically is, it, does that
That
mean, yes,
include-
it includes the
yes.
admin cost? Okay.
That includes admin costs. Thank
All
you.
right, great. I think that are all my costs, my questions on those costs. I just had related set of questions on the GSC. Ms. Prescott, you're probably going to respond to these as well. I just wanted to confirm, I didn't see in the proposed adjustment to the GSC any staffing costs for UI to fulfill its self-supply activity. There's been discussions both pursuant to the 2012 and 2018 procurement plan about self-supply capabilities, and then more recently through Public Act 25-173 and the proposed procurement plan in 12-0602 REO4. So to be honest, I thought we might see some hiring happening. So I just wanted to confirm my conclusion was accurate, that there wasn't any costs passed through this year's RAM, and my assumption that that's because that hasn't occurred yet.
So just to be clear, so the question is that.
Sorry, that was a lot.
Yeah, no, just to be clear that I heard you, let me just, maybe I could restate what I think I heard you ask, which is in this year's RAM docket, where we also present the GSC costs, we have not proposed an increase in administrative adder, which you would anticipate would be the place where we would request additional staffing.
So last year in the RAM proceeding, we asked some interrogatories and I asked a couple questions at the hearing, and the feedback we received from the company was the GSC was the appropriate place where you would seek recovery for
Yes.
those additional staff costs. And given the activity that has occurred from last year to this year on this, I wanted to make sure the GSC does not in fact include any staffing costs, and confirm that's because there haven't been any new staff hired related to the procurement activity.
Thank you. Okay. No, we have not hired any additional staff for self-supply activities under the GSC. We also didn't propose any as part of the known and measurable filing, as at the time of the known and measurable filing in January of 26, we didn't have the final decision from docket
0602 REO 4 or 5.
That
now.
one was 3, and then we have 4 open now, but I could be off by a reopener or 2.
It's 120602 REO 4 that provided,
1206.
yep.
Everybody got it? Sorry, there's too many dockets. But nonetheless, we have not made a change. I don't think it was known and measurable at the time when we did the January filing that we would, in fact, there would be a recommendation for self-supply. And so we currently have not made any change.
So, okay, so even though Public Act 25-173 directed that the procurement plan require each EDC develop and maintain the ability to engage in dynamic market purchases for not less than 25% of standard service load, that didn't trigger any conclusion that you would be required to do that?
No, I'm familiar with that language. I think that the way we interpreted that language was that it was part of the procurement plan that was being examined by the authority, and that was what was examined in the recommendation from that decision in April. We were waiting for that decision.
So in UI's view, until PURA says UI has to do this, you're waiting to plan for and staff up for those capabilities.
Correct. We didn't think it would be prudent to hire staffing for an activity that we may or may not be utilizing.
Okay, thank you. I do not have any more questions. Anyone? I think the OCC is done.
All right. Thank you. I have a quick follow-up on the discussion about the netting. Maybe it's not that quick. And I think I probably asked this before. I think Mr. Kolka, I've had this conversation with you in prior years maybe, but these costs don't account for the what I think of as missing or lost sales associated with the solar programs, correct? Meaning, like, I'm a solar customer, I use 400 kilowatt hours of energy from the grid, I produce 400 kilowatt hours of energy, UI gets $0, but nonetheless, that I have imposed costs upon the grid, distribution costs that I'm not contributing. Those costs ultimately are recovered through decoupling, right? Is that correct?
I'm going to take a crack at this. There was a data request that I cannot remember the number of in this year's RAM on this topic. And I'm going to get some of the technical words wrong because it's not my area, but my understanding is that the netting program occurs under like NECET1 or something is our tariff. And each customer has a kilowatt hour bank, and that kilowatt hour bank is addressed monthly on a non-financial basis. But in addressing that kilowatt hour bank on a non-financial basis, to the kind of point of your question, our sales are impacted and our revenues are impacted, but that might not result in a cash payment to the customer. Once per year, I think following the kilowatt hour bank year ending in March, I want to say, there is a financial transaction to, if necessary, clear the bank for each customer. And it is only that final financial transaction that goes through the RDM.
Okay, and that bank is only for the production in excess of usage though, right? So like you're not banking, again, my hypothetical was like, imagine a perfect scenario where you're using as much, you're producing exactly as much as you use. That would have zero impact on the bank, but would have an impact on your distribution revenue, meaning you get none from that customer. And then, so imagine I'll back up a little. Imagine a hypothetical where you have two customers. One is enrolled in a netting program and one is not. You have a revenue requirement of $1,000. The customer, and let's say they both customers impose $500 of costs onto you to derive that revenue requirement. The netting customer produces exactly the amount of energy that it takes from the grid across a year. You get $0 from that customer, 500 from the other customer. You're going to need to get 500 from the other customer via decoupling to be made whole, right?
That is my understanding. I'm just going to confer with some of my friends here to make sure we all understand it the same way, because this is a little outside of my typical wheelhouse.
Okay. And ultimately what I'm getting at here is like, I think I guess the broader question is it unfair to consider that also as a cost of the program, of these programs? That's the question.
I gotcha. I just want to make sure I got the mechanics right before opining. Thank you for the patience. I'm going to start the answer and then invite my colleagues to add on to the extent they see fit. I think the concept of your hypothetical is consistent with our understanding. I would say that getting at kind of your question about what happens to can't you count the lost load as a cost in effect? I don't know that it would all go to the RDM in that example. If we have $1,000 revenue requirement, we collect 500 from one customer, 0 from the other. Whether the 500 missing dollars all go through the RDM or rather get reflected in, the MBFMCC, the SBC, et cetera, depends on the nature of what gave rise to that $1,000 revenue requirement. But I think in concept that we agree with the hypotheticals you've laid it out. And just to opine on whether that is truly a cost or not, I think I certainly see your point. I think it has merit. You could argue cost to whom, because it's a cost to some customers, benefit to others. And I think this is an instance where the regulator, i.e. PIRA, has deviated from the principle of cost causation. And I say that not to say that it's wrong or shouldn't have been done. We're not here proposing any specific changes relative to this. And in fact, this appears to be a time where the principle of cost causation runs in conflict with other principles underlying rate making. And this isn't the first time that has happened. Often the principle of cost causation comes in conflict with the principle of furthering public policy goals. For example, the low income discount rate. If we were to strictly adhere to the principle of cost causation, we would assign the cost of the low income discount to precisely those customers we are trying to provide a benefit to. So I don't mean to say that that is inappropriate, but I think there is some there to your question, but it's difficult for us to quantify, and we're kind of reacting on the fly because it raises the question of cost to whom. It's cost to some customers in that they, in your hypothetical, the one customer who paid 500 will likely have to bear the 500 missing dollars, but by that same token, it's a $500 benefit to the other guy. So that may not directly answer your question, but those are some thoughts for your consideration.
Thanks. That all makes sense. I guess I was just asking, imagine hypothetically you were a state agency charged with having to issue a report to the legislature explaining how much things cost.
Hypothetically.
Hypothetically. Do you think it would make sense to consider both decoupling and, get into what you were getting at before? I think that hypothetically, based on my other scenario, you mentioned the NBFMCC. Well, that would mean if there is an under or over recovery, that's where that would end up, right? So, and I agree, it's not the idea inherent in decoupling is that there isn't an incremental cost to the company, but it's ultimately an allocation question. But I guess my question is it fair to consider these things when you're trying to answer the question of what exactly are all ratepayers paying for as driven by these programs?
Well, it's certainly not for me to hypothetically tell PIRA what to do, but just what is running through my head is a guidance that I often give my team when we get discovery, which is the first 3 most important rules are to tell the truth, tell the truth, tell the truth, tell the truth. But also it's important to be clear. If we can't exactly answer the question that's been asked of us for whatever reason, well, let's just make sure that we're explaining what we are providing, what we're not providing, and why. So if I were hypothetically preparing a report to the legislator regarding the cost of some program, I personally am not familiar enough with these programs to know what would go into attempting to quantify the thing that you're picking at. It strikes me it's potentially possible. It also strikes me that potentially quite complicated. So I would think whatever path you choose to go down, my number one priority, if I were in your hypothetical shoes, would be to just be as clear as possible about what we're doing and what we're not. And maybe this is something that is omitted from a report this year and added next year. I don't know if it's a recurring thing, but that may not help you, but those are some words that I've said.
Thank you. And my last question is, I can't remember whether I've asked UI this before. I do remember asking Eversource. I'm not asking, certainly not asking the company to do this as a late file in this proceeding, but it's just a hypothetical, just a general question of theoretically, would this make sense? Would it make sense to capture the an all-in program costs other than administrative costs? If we're trying to capture the actual energy costs of a particular program, couldn't you just take the total sum of, you could take all the billing information from the customers who are enrolled in that program, take the ultimate kilowatt hours that pass through their meter into their homes, and then take the total revenue recovered from those customers. I guess you'd have to imagine there's a world where uncollectibles don't exist. Couldn't that get you there? Like, wouldn't that data be helpful to sort of see how much energy did this class of customers use and how much did they ultimately pay for it at the end of the year?
So to bring your question back to the two customer hypothetical for a minute, you'd be seeking to undertake an analysis that quantifies the 500 missing dollars, basically, from the second customer.
Yeah, I mean, I think it seems to me like that could capture how much did they use and how much did they pay, and if you compared that to customers who aren't enrolled in the program, who pay hypothetically the same volumetric rates.
Yeah.
Couldn't you compare those two numbers to say this is the program, like this is the cost shift, for lack of other terms, from program participants to non-program participants?
So again, I'll say a couple words and then invite my colleagues to add to the extent they'd like. And we're talking about something with which I'm not that familiar, and I'll make it even worse by drawing a parallel to a program for an affiliate of UI with which I'm also not that familiar. But the central main power company has, they call it net energy billing. It's similar, I'm sure not the same, but similar to these netting programs here. And like UI, they've had some different iterations of these programs, and I'm the transmission guy, so I deal with matters that relate to transmission. And for CMP, the retail transmission rates, i.e. the rates approved by the Maine Public Utility Commission to collect the costs assigned to CMP's customers based on FERC formula rates, are set based on a sales forecast that was derived in the rate case. And load in Maine evolves considerably each year, and now that forecast has become quite stale. It's 4 to 5 years old, and as a result, CMP is habitually under recovering its transmission costs at the retail level. And to put some numbers to the drivers of that under recovery, we undertook an analysis that's conceptually similar to what you've described. We tried to capture those kilowatt hours that I'll say colloquially went unpaid because of the net energy billing program, and their particular net energy, one of their flavors of the net energy billing program in the state of Maine, some of that occurred behind the meter. So there was sales that we as the utility could not see. And we did a couple of things to try to estimate that, working with people who are far, far more knowledgeable of the programs than I am. And we put together something that we shared with some of the parties in that state that tried to put some numbers to that under recovery, because we're always chasing. I don't know enough about the nature of UI's programs myself, but I suspect something would be possible. Maybe it needs some assumptions like we had to do in Maine for those sales that we can't see. Maybe it's simpler because of the design of our programs. I don't know, but it strikes me as there's got to be a way to do something to do it. I don't know what we could do now. I don't know how much, if there would be investment required to make it better. I'm not familiar with that sitting here today, but I think you would have to be careful about the cost to who question, because it's money that we're not recovering, but then recovering through a different vehicle. So does that count as a cost? Again, I think the most important thing would be to be clear, but it strikes me that with enough knowledge about the program and enough knowledge about the company's systems, it must be possible to do something. It's just a matter of how caveated or assumptions-based that something would have to be.
All right, thank you. Next on the, if OCC's all set, next on the list is Deep. Did you have any cross? Attorney Niagara? No questions? Okay. I haven't seen CIEC. Okay, so that leaves redirect. Do you want to take a moment to discuss?
Could we have until 2:30?
Sure. I also almost shorted my colleagues here, though, to make sure there was no more questions from the bench before we go to redirect.
2:34.
Okay, but does anyone have any questions from the bench first? Okay,
Quick one.
sure.
And I'll try to be brief, and this was with regard to the billing systems. I think you indicated that, and I'll wait for my friend to get up here, that you may be looking at reassessing, rebidding at some stage in the future. Do you have that built into your sort of cycle?
When you say cycle, I just want to.
You indicated, that you'd been with this legacy vendor since 2018, that you were reluctant to make changes, particularly where there were many different elements you were then attempting to build in the system. But I think you indicated that at some point you would be looking again at your billing system components. And I wondered if you had a timeline on that.
Similar to any component that we have in place, in particular the billing system, it becomes there becomes a point where it becomes end of life, and then you're seeking to replace that system. So we're in the process of looking at a solution across Avangrid that will migrate us from a platform that will become unsupported at some point to one of the newer SAP platforms. So we're in the process of
But
selecting.
you have no particular date in mind at this point. It just
Tentative
on the
dates
horizon at some.
on the horizon, no specific date that I can give you today.
All right. Thank you. Thank you, Mr. Chair.
Okay, Attorney Vaughn, your request to go back in time to 2:30 is denied. Do you?
I was gonna lump in there. If we could have 5 minutes, Chairman,
Sure.
that'd be great.
We'll break for 5 minutes. But I think I think the plan is to not change. I'm getting a thumbs up. I think the plan is to not change the following dates. So late file exhibits are due the 8th. Late file hearing, if requested, will be on June 15th. Briefs are due June 22nd. Proposed final decision, July 17th. Exceptions, the 29th of July. Oral arguments, if requested, August 4th. And final decision is scheduled for our vote on August 19th. So thanks for everyone's participation today, and we will maybe see you again on the 15th for a late file hearing. Thanks. Have a good day.
Thank you.